So he has over 20 years of investment and trading experience in many areas, in stocks, bonds, mutual funds, real estate, currencies, you name it. You'll see that when he start talking about it, he's very passionate about talking about those things, that what he does. So one of the things we asked many times, try to see if we can get someone who is in the teaching industry, and also this is something based on the feedback we got from our
So welcome, ladies and gentlemen, to another stock basics trading class, investing class. What you have here right there on as a disclaimer, just so you know, ladies and gentlemen, that this is purely just for educational purposes only. I'm not giving you any kind of advice or anything like that. You really should do your own due diligence. Whenever you're investing carries on some sort of risk, and you can lose all of your money, and you can lose more than all of your money as well. So
Can you make a PowerPoint view?
yes, so the PowerPoint should be viewing. I'm sharing that.
You put on slideshow.
Oh, I'm so sorry. Okay. All righty. So how's that? Can you guys see that? Sorry about that. All right. People who are
Yours is showing.
okay. So you have it on there as well.
Oh, now,
Okay. All right, so for people here that weren't able to see the slides. So you can read that disclaimer there. The disclaimer that's written in caps, that comes from the National Futures Association. So sometimes I do tend to dabble in futures. We can talk about that later on. But today, let's just talk about investing, and we'll talk about just stocks and what are they, and what are dividends. And we'll talk also about the different types of orders to get in and to get out of the various different securities that you might be interested in investing in. There's also a major difference between, oh, thank you very much. There's a major difference between trading and investing. So today we're going to really focus on investing today. Later on, perhaps we can talk about trading. I also have some other things that I talk about. I'll just give you a little taste of what I do and some of the research that I'm working on as well, which is on psychology and decision-making, and emotional and rational decision-making. Then we'll probably wrap it up with some options, some things that I use. So I tell to hedge sometimes, and we'll talk about that a little bit later on, if you'd like to, explore that option. And I'll give you some future thoughts as well, things that I'm interested in doing when it comes to investments, and some of the things that I'm currently in as well. So let's move on. This slide I've shown several times over, and it's very important to remember that since you're here today, you have to understand that this is not just a one-time thing. This is not like going to the gym and figuring out what machine is going to help you lose weight within 2 weeks. That's not going to happen. It's not a matter of just watching videos online. You actually have to do this. You have to get burned a few times. You will lose. I don't know a single person who's been in this business, including myself, who has not lost substantial sums of money. However, you have to understand also that you do not want to risk any more than what you can afford. So the very first thing you should always have before even contemplating investing is that you should always have some sort of emergency or backup fund. If you don't have that, you should not be in this business. The other thing that you should also consider is that you cannot just continue to work forever. That's a huge risk that you're taking on in life. So you have to consider alternative streams of income. Investing in securities is one way. There are many others, but today we'll focus on the investments in securities. All right, so let's move on. Oh no, there we go. This is another slide. You should know your own risk tolerance. One of the beauties about being in the equities market or in stocks is that stocks are always going to be liquid. There's a bid and there's an offer price. I want you to think about this in terms of trying to buy a house. when you're trying to buy a house, you're usually going to pay what? The lowest offering price. So for example, if there is a house that you'd like to buy for, let's say, $500,000, but the asking price is $550,000. If you want to buy that house right then and there, the price that you're going to pay is going to be $550,000. There's no chance that you're going to get that down to to $500,000. The reason being is because you want to buy it at that market price. The market price, someone is offering that house for $550,000. Now, on the flip side, if you're looking to sell your house, if you have your own house and you would like to sell, if you'd like to sell your house for about $500,000, and there's the bid is $490,000. If that's the case, and you want to sell it right away, you're going to sell it at $490,000 regardless. All right? So that's an illiquid market, if you will. Securities are going to be a much more liquid market because as soon as they open up at 9:30 in the morning here in the Northeast, on the East Coast, you can trade stocks on the New York Stock Exchange, on the NASDAQ, or on the American Exchange, and so forth. All right? So with that, that's just a little brief introduction, and I'd like to kind of know about what are you guys looking to get out of this course for today. I have a lot of material planned, and so you can type it in the chat box right now, and we can go over that. But primarily, I have my own agenda. But if you guys have anything in particular, any kind of questions or anything that you would like to really know or get out from today, please type it in now, and I'll gladly go over it now. All right? Are there any questions from the audience?
To get it out?
Or you can type it in the text. Yeah, or you can unmute it. It's fine.
Just so they're interacting.
Okay,
I'll write it down.
that's fine.
And you can switch the camera down.
That's fine. That's okay.
So the eraser?
Yeah, you can use that. All right.
And it all.
Okay.
Speak up, now's your chance.
Now's your chance to ask any kind of questions.
The topics.
Or topics, actually, not questions. Questions we say for, yeah.
Topics you're looking for today. Speak up, please. Yeah.
Can you guys hear out? You should be unmuted.
Long-term investment strategies, okay. So that's one thing, okay.
Long-term investment strategy.
You can unmute your phone. Also, you can speak. It's better to have interactive, otherwise you're not paying attention.
I'm not the principal here.
We know it's early
How to
Saturday.
reduce the losses while investing? That's an awesome one.
Reduce losses.
Yes, that's an awesome
That's a
one.
good one.
There's a whole class on that.
Is it possible to mute everybody?
Mute everyone.
Unmute everyone?
Unmute all. Yeah, unmute all.
Okay, everybody's unmuted. Now's your chance.
You can use this one. Some background. All right.
You can type it in or tell us which topics you're looking for.
So we have two so far, and the two are really good ones. One would be options basics and investment strategies and long-term investments. So I'm going to tie those two together. And the other one is how to reduce losses while investing. All right. That's excellent.
Everyone, you can unmute. I know I'm unmuting. You are muted back to your phone.
All right.
So
This is good. We have another one too. So I think we're good with this. So we've got 4 of them, and we can kind of link 2 of them together. One would be long-term investment strategies. Another one is interested in options basics and investment strategies. You can use options for your long-term investment strategies. We'll talk about that a little bit later on. Also, how to reduce the losses while investing, and how to trade or invest with proper knowledge to minimize the risk. And that also brings us back to options. How can we make use of technicals and fundamentals to make buy or sell decisions? All right, like that I'm not going to talk about today because that is going to be, that's going to be at another.
Hold on, Yasser. Yasser, what people are saying is unstable.
Sure.
Internet connection.
All right, there's an unstable connection. More covered calls too. Okay, so that's a good one as well. So covered calls also would be hedging. So I'm not going to talk about all the probabilities that come into play with when it comes with options, but I'll be happy to talk about that a little bit later on. All right, I think I've got people who are working on the tech support over here, and we just don't want the laptop to drop. All right. Okay. All righty. Okay over there, Ruchi? Okay. How you doing over there? All right. So what's going on here? What are we trying to do here? Okay, read.
Okay, how about now?
How about now?
How about now?
Why don't you bring that in a little bit closer? That projector a little bit in. There we go. All right. When you're sitting down, you can see the screen, right? Javed?
Yes.
Can you see the screen?
Yes.
All right, because I'm sharing my
Smaller.
video. I'm sharing this video,
Okay.
so people can see my screen here, so that's not a big deal.
Can you ask him how the internet connection is now?
How's the internet connection, ladies and gentlemen, out there? Because we've been getting unstable signals. All right, it's fine, internet is good. Good.
Great.
That's great.
Problem solved.
Excellent. All right. All right, so if we can come back to, we can show back our room here. There we go. All right, you guys can see lag on the internet. Okay, so 2 people said it's fine. 1 says it's a little laggy. All right.
Still a little laggy?
All right, one more time if you can, please, Asa.
You're connected as well?
Yep. Okay, cool. Thank you, Dewan, for your suggestion. All right, so we'll talk, that deals with a little bit more with options, your suggestion on buying stocks when they come at a discount. How much to put aside. Oh, I don't know if that was a pun on words or not, but to put aside for the surprise discounts and how much to put in the market. Strategies like that would be helpful. All right, so I'll give you one strategy that I'd like to look at when it comes to that. So, but let's just talk about what are securities. So some people may not know what securities are. So I just want to briefly go over what some of these securities are. And if you take a look, I want you to keep one thing in mind on this slide over here for getting in and getting out. One thing that I really like to use, I mentioned this to my best friend here as well, mentioned slobs are always going to be over bliss. So slobs, just think about slobs being over bliss. And that's going to help you to remember what prices you're going to get in at and what prices you're going to get out. All right, so that's what's on tap primarily is the tradable securities and dividend. How to hedge some of your losses or how to get in. I put call options, but I'll put some put options because someone asked about getting in at a discount price, right? And I also have 3 courses that, you know, they're a lot more substantial. We get into far more in depth on these. That you can't learn this all in one morning, but we're happy that you're here on a Saturday morning and trying to learn a little bit about this. All righty, so let's move on. And All right. So what are common shares of stock? For some people who have no idea, shares of stock are publicly, they're certificates or they're pieces of a publicly traded company on some kind of an exchange. And the reason why they are considered publicly traded is because anyone in the public can buy them. So I can buy them, you can buy them, anybody here, as long as, within reason. Some people, they just can't afford to buy them. But you should be able to just buy and sell pieces of a company out in the open public market. Now, because they're publicly traded, they are responsible to those shareholders who are part of the public. So if you have your own private company, you don't have to divulge all the information with that privately held firm. However, if it's a publicly traded company, well, that's a little bit different. You have to report earnings, you have to report your profits, you have to tell us about your books, so the whole public can find out about how well your firm is doing. And you can look at the entire industry. So if we're looking at, let's say, Johnson & Johnson, we can also look at Procter & Gamble, right? Those two are competitors in that industry. If we're looking at the Coca-Cola company, that's a publicly traded firm. We can also look at PepsiCo. So again, we can find out how much money they made in the last year or in the last quarter. ExxonMobil versus Chevron Texaco. Look at that as well. And so shares of a firm allows you to be a part owner of that firm. So sometimes some people, a few years ago, the Green Bay Packers, the football team, they issued shares and they told people you can buy shares of this brand, this firm, and it gave some owners a sense of pride to be a part owner of their team. So it wasn't just a matter of, okay, we're just fans, but we're also owners of this firm as well. That was a special case, but for most publicly traded firms, you're allowed to, move this away, you're allowed to receive profits. And usually those profits are in the form of dividends. And so dividends are paid out either quarterly or annually, or sometimes there's special dividends that are paid, but those are from the profits that the firm makes. So if you own shares of that particular firm, you're entitled to receive profits because you are a part owner of that firm. So one of the things that I do like to do is if I'm going to invest, at the very least, I'm going to look at a company that pays dividends. So a way to offset my losses is if I'm looking at, let's say, a company like ExxonMobil, if I'm looking at a company like Chevron or BP, now those are energy stocks. And I know they're defensive in the sense that they're pretty well insulated from market fluctuations, relatively speaking. So each quarter, firms such as the ones I just mentioned in the energy industry, in the energy sector, they pay dividends and they pay about 4% in some cases. So I'd like to earn 4% on my money. And these companies generally aren't going to go out of business. Even with the Gulf of Mexico disaster less than a decade ago for BP, they're still alive and they're still well and they're still doing well. They're not out of business. So some people who bought them just for the dividends, granted, they had to halt the dividends for a little while because they had to pay for some of the mess. However, they bounced back, right? Now, the thing to keep in mind with common stocks is that if the value of the company increases, then the value of the shares increase. But if the value of the firm decreases, then so too does the share price as well. The good thing about owning shares of a firm is that they never expire. With options, which I'll talk about a little bit later on, options do expire, but shares of a company never expire, right? So for example, I have one company that I've held for 7 years. They are terrible. They're like the dog of my portfolio. I've lost thousands of dollars with them. Hey, that's great. Well, they're only good for one thing at this point. Their dividends are just being cut. Their growth is low. Their profitability is low. Their management is not great. but the stocks don't expire. So I know that they have yet to go bankrupt. And so every single quarter, I still continue to get some kind of dividend from that firm. The only reason why I hold on to them now, thankfully, is because they're a dog of my portfolio. And anytime I make money from other places, I do need to offset those profits and to take some kind of losses. And that's why I still have some shares left. And every time I make a little bit extra, I just happen to sell some of my losers. So someone asked about when to get in and get out, right? This was a mistake of mine. Like I said, I've held them for probably since 2000. I got into them in about 2009, so a decade ago. Did not know as much back then. But that's all right. Now, hopefully, you wouldn't make that mistake that I made. You would never stay in something for that long. All right. So, all right. Let's go to this next slide. Oh, before I forget, I always operate a judgment-free zone. So at this point, if you'd like to share some of your war stories or your horror stories about any particular firm, and you probably bought at the peak and you sold at the trough, you can feel free to put it in here. That's fine. I can tell you about the companies probably during the break that I've invested in, that I've lost money in. And I can tell you the ones that I was very happy with, but you know, past performance is no indication of future earnings. All right. So these are some of the things that I just mentioned before. I mentioned pieces or shares of a firm. You can get certificates, paper certificates. Usually you open an online trading account with some kind of a broker, you know, like a TD Ameritrade or, you know, Fidelity or Wells Fargo, and so many others. I'm not endorsing one or the other over the other. And again,
yeah, I have one more. So we have some more stories.
You do? Yeah. So please.
And then we'll start it off, and then if somebody wants to unmute themselves, they
Okay. All right. So we have a couple of war stories.
I'll tell a war story. I think everybody loves to talk about their experience with winning and losing.
Sure.
So where's the mic? Is the mic on?
The mic is right here. You guys can hear.
Okay, so I can just get close.
You guys can hear Javid, right?
Can you hear me? Anybody having trouble hearing me? This is Javid.
Okay, one person can hear you.
Okay, great. So, war story. It was back 20 years ago, literally. This was the dot-com bubble, and I didn't know it was a bubble back then. So I bought right into it. Qualcomm stock, and Qualcomm's still around now.
Yeah, they are.
And Qualcomm was going through the roof. And there was an analyst who put $1,000 price target. And back then, $1,000 stock was a really big deal. So before he did that, I bought Qualcomm call option for $5,000. So that means $50 a call. So the whole one contract was $5,000. And this guy, it was right before the Christmas weekend. And this analyst comes out on CNBC. He's like, I have $1,000 price target on the stock. And it was only maybe $600-700 at that time. This stock went up by like $100. It was insane. And then my $5,000 position went to $20,000. This is back in '98. I was like an analyst. That was my first job. That was a lot of money for me to make like in a week.
Of course. So what happened?
And then this is where the war story part comes along.
Oh, no.
Stock split 4-for-1. Okay. I was like, I'm going to take my gains. And what happened is I tried to sell my calls, but instead of selling all 4, I only sold 1. Oh. Sure enough, the calls went to 0. However, you know, I got lucky, better lucky than good. I already sold one of them for around $5,000. Okay. And so I kind of made my money back, sure. You know, but greed. You know, and I know you're going to talk about it, but yes. I actually could have sold the other 3. I knew my mistake right away before the stock went down. Sure. But I was greedy, and I was going to let them run, and they ran not up, they ran down to 0. Oh. So that was like the biggest win I ever made and the biggest loss I ever made, sure. All within probably the span of like a month. A month or two.
Wow.
Yeah, that's my war story.
Okay.
Mushi got in the one?
Yeah. She has one as well.
Yeah. This is, I'm going to go back like what Javed did. You know, back then I'm sure most of you heard about Lucent, right? Company Lucent.
Yes.
Binian,
Yes.
Satyam. Those company, I think those who is in IT, they may know those company, and also Qualcomm. I invested in all those company. That's in year around 2000. But I don't do options any of all straight stock. But when I invest big time, meaning I at least I remember I put $200,000 in my account. So when I say you so when I said I can buy all of those, which is good. Like and just like Javed's profile, I had over $500,000. And I thought, oh, it's really good.
Yeah.
Have you heard about Priceline? Yes.
Priceline as well, yes.
Priceline, I bought Priceline.
Shatner.
Yeah, I bought Priceline less than $50. You know, and it went, but then what happened? Year 2000 came in, 2000, 2001, and slowly, and I am investment on the investment banker side at Merrill Lynch. I was working. When those who know investment banking side, if you work on the trading floor there, you have no life. I couldn't follow up my account for a while. So after few weeks, one time I saw that my portfolio went down from $500,000 to like 220. And I thought, oh, then internally I was talking to a bunch of Merrill Lynch research guys. What do you think? Should I sell whatever I got? No, it's gonna come around. Don't sell.
Famous last words.
Don't sell, just come around. So because it's our stock, so one mistake I made, I went greedy that I opened an account with margin account. So, and then I've been getting margin call, and then that's okay, do not sell it, just keep it, cover the margin. By covering the margin, I started losing money, and after a while, I said, you know what, I'm not going to look at it, but I'm going to keep feeding them until I can recover. So then market got crashed, and I totally gave up everything what I was doing there. But I lost all the money because margin, what happened, my account was TD sold to cover their margin. So the mistake, those who are doing it, whatever you do, you can play with your own money. Don't go after or going, hey, margin, let's say with the margin you can use. Nowadays I see Robinhood gives you that kind of, I have account with Robin, TD, both platform now. And people just, oh yeah, I'm a gold subscriber, but then ended up using their money, but then they will take it out if you cannot cover the margin call.
So just if I can step in here just for a moment, can you guys hear me? Because I know you said that there was some echo. How about now? Is there still an echo, ladies and gentlemen? Okay, that's fine. So for some of you guys who may not know what a margin account is, thank you for those two examples. My example, I will tell you about a little bit later on, because it also involves different types of orders to get in and get out. But okay, so one person did mention that they've gotten burnt by margin. Again, there's no judging here. So the problem with margin is, you only have to put down a certain percentage of the entire position. So for example, if I need to buy a house, I only need to put down a down payment. But if the value of the house goes down, way down, what did people do in 2008, 2009, 2010? What do you guys think happened? Yeah, they put down their down payment of, let's say, $20,000, let's say, for a $500,000 home. But when that house became worth only $350,000, what do you think they did? Anyone?
So folks, unmute your line and speak.
You can speak or you can type. I'm just waiting to see.
But it's better if you unmute your line and speak.
That's fine.
We know who you are.
Either way is fine. Well, a lot of people walked away and they just let their homes just whittle away and get foreclosed on because they realized it wasn't even worth it. Now that's going to affect their credit for the rest of their lives. The same thing with the margin call. If you're trading using a margin account, let's say I believe that company ABC is really going to go through the roof. Fine. At that point, let's say, I want to buy 100 shares of company ABC at a certain price. And I believe I'm going to go all in. I'm going to borrow money from the broker to buy as many shares as I possibly can. The problem is, it never gets to that price. Or even worse, it goes down and you can no longer afford to hold that position. Because guess what? The broker themselves is doing what? They're telling you, we are going to loan you that money. But we got to make sure what? The price doesn't go down way too low. If it does, we don't want to lose our money. You're going to lose because you already own shares of it. And then the broker's going to lose because they've already loaned you money and they're losing it. So they're scared. So what are they going to do? They're A, going to charge you either an exorbitant amount of interest, or B, they're going to do something else. They're going to give you a margin call. And you have, I think, up to 3 days to cover it, to put in more funds into the account in order to make sure that you can maintain the amount that you need in order to stay in that position. If you can't, you get a margin call. And actually what could happen too is you can get that margin call and you can close out your position, and unfortunately, guess what happens? We'll get to it.
Okay.
Can you guys hear me? All right. Okay. I thought somebody had a question that was on the audio. That's fine. Either way is fine. Okay. So let's move on. So I think everybody here understands what a margin call is and to never, ever, ever get a margin call. So we want to make sure that we never do that. All right. Okay. So, this is an entitlement page for people who actually own shares of a firm. I don't know if a lot of people realize this, but you can actually submit proposals to a firm. Some firms tell you if you own 100 shares of their particular firm, you can actually write and put proposals and say, I want this to be on the docket, or I want this to be discussed and voted on at the next shareholders meeting. And so I've seen that. I've seen people actually write to big Fortune 500 firms that I've owned shares of shares of stock of that particular firm, and I'll see them. I'll read through the annual report and I'll see, what's to be voted on at the shareholders meeting. So I can vote with my shares because I'm an owner. Right? So you can vote on board members as well. And of course, when you're buying shares of a company, you're participating in the growth or decline in the firm. Okay. And like we said before, you can collect any dividends or any kind of profits that the management will distribute to the owners. So I think we have a question. Dividend stocks are good, but what good are they if they keep reducing in price over many years? Okay. Many companies who have paid dividends consistently keep going down slowly over years. Isn't that a decaying money? I don't know what decaying money really means, but here's the thing. You have to look at the company itself, all right? So sometimes when you're looking at the firm, if they keep reducing in price, I'll give you an example. I looked at Chevron. Oh, I loved Chevron. This is not an endorsement of Chevron, but one of the things I really liked about them is that as oil was still suppressed in price, they kept paying the same dividend. All right? But we are like 0.0005%. How will our votes matter? All right, well, let me answer your first question first, Duan, and then I'll get to your second one. So in this case, the share price of Chevron went from, at the time, from I think $90 down to $63. And they just kept paying dividends. So fine, there's a reduction in price. And that's okay. It's an investment. Remember, shares of stock never expire. So we're not looking at it as a trade. We're looking at it for maybe 5 to 7 years. We're looking at it maybe giving these shares to our grandchildren in the future. So in that case, that's fine if the dividend still gets paid. We at least get something out of it until the firm can recover or its share price can recover. So some things that you have to consider would be the management. You'd have to look at the management. Is the management really decaying? Is the management going down? Is the management making the wrong decisions? What's happening here? So it might actually make sense to hold on through the rough times. Of course, you do have opportunity cost, and you may want to go and invest it somewhere else. If you do have that kind of an opportunity, then you may want to sell them for a loss and move on to something else. However, my personal situation, and this happened for me, I didn't need the funds, and I just kept collecting dividends for about 5 years, and the price was less than what the price I had paid for. I think I bought them high. It was around 90. They went to 60, and they stayed in the 80s for a long time. And I just kept collecting dividends because I was fine with the firm. But your second question, but we are like such a small percentage, how will our votes matter? You know, it's really funny. You know, it's not just your votes. It's the proposal that you can give. So again, I remember reading something saying, you know, this person, and I think it was Chevron. I can't remember the firm. Maybe it wasn't. But, you know, it was really cool to see somebody who just owned 100 shares of stock of this firm, and it wasn't like this firm was being traded in the thousands and thousands of dollars. Here's this one person, or this one, I forget, maybe it was like an investment club or something like that, but they had a proposal. I don't even remember the proposal. But you're saying that how will your votes matter? Forget your votes. You can actually put in a proposal. And I thought that was pretty wicked, right? Here I am, you own probably less than the percentage you put out there, right? And guess what? You can have an impact on the firm. I thought that was pretty neat. So how will your votes matter? It's not your votes, it's everybody else's votes. They're going to read your proposal because the firm itself has to put your proposal in their, you know, in their agenda, and they have to make sure that it gets voted on. So you put your case in that proposal. And so maybe if you own 100 shares, your vote may or may not matter, right, as much as somebody who owns, let's say, 50,000 shares. But guess what? If enough people are convinced with your arguments in your proposal, then guess what? The proposal can pass.
Can I jump in there for a second?
Sure, by all means.
What's the ultimate way to vote? You can vote with your feet as well, right?
Yes, yes. That's another way. So if you don't like the firm, guess what? You sell your shares. Someone else sells their shares. Now everybody's going for the exits, headed for the exits to sell their shares, and the management will have to figure out exactly, voting with your feet. They have to figure out something has to be done, or else there are too many people who are leaving. All right? That wakes management up, absolutely. Yep, all right. Proposals, examples, like in what areas can we give proposals? What is our limit? I'm not sure, I can't remember because I haven't been in stocks for some time. I'm usually in funds now, index funds, but a proposal is something that, oh man, we're talking over a decade ago on this proposal. If I remember correctly, this group did not like what the management was presenting, and they presented a different way of doing business in a foreign country. And you can give proposals in anything. But I don't know what is your limit. I think your limit is you have to have at least 100 shares.
A lot of times I see proposals in proxies where they want companies to be more environmentally friendly.
Sure, exactly. Yep, that was probably it, because it was an oil company. Yep. So thank you, Javed, on that one. So you can give proposals essentially in anything. So yeah, maybe you want to be a little bit more environmentally friendly, or maybe you want to see some social justice or something, and so that could be a proposal. So those are ways that you can participate in actually the direction of the firm as a shareholder. All right. Okay, so some other things to consider when we're talking about companies and their share price. What you have here is something to consider with common shareholders. They are the first people in line to make any kind of profits. But guess what? They are the very last people to recover any costs. So if a company goes bankrupt, the last people to see any kind of money, if they see any kind of money, will be the common shareholders. But usually, that's what? That's compensated on the flip side with what? If the company goes up, then the shareholders usually, the shareholders are the first in line to reap those rewards. Sometimes firms borrow to pay their dividends as well. So I remember, again, I was looking at Chevron, and I looked at their dividend, just the amount that they paid, So let's say it was, hypothetically, let's say it was $4.28 a year. They made sure that, okay, the next year they wanted to pay $4.32 or something like that, even though the price of oil was down. All right, so some things to consider would be like a dividend yield. So if you buy shares of company XYZ at $100 a share, and they're paying a dividend of every 3 months, that's $1 a year. So that dividend yield would be 1%. So if you hold those shares for a full year, you're going to get 1% on the money that you put in. As long as you don't sell your shares. And there's something else to consider. You're going to hold on to them for a year, for 2 years, for 3 years. Whatever if that dividend does not change, you're still going to continue to make 1% a year. All right? So sometimes what you might want to do is, even if you're retired, you can even consider this. If you're going to buy in a defensive stock, a company that's really not going anywhere, and you're going to put in X amount of dollars. Afterwards, what do you think? That dividend does not change. That dividend is not going to change. And if they increase it, they increase it. But if they decrease it, you may actually go for relief. But if you're in there and you're there year after year after year, if you put in $1 million to buy X amount of shares and they were paying 4% on that $1 million, if the price goes up, if the price goes down, you're not buying, you're not selling, you're not doing anything, you're still going to collect that same dividend. The one thing that you want to be able to do is that you want to buy them before something called the ex-dividend date. Once you get to the ex-dividend date, the shareholders of record by that date are going to do what? They're going to be entitled to actually receiving their profits. The last but not least, I like to look at the dividend payout ratio. Now, this is something that people don't really look at. It's not very common. The dividend payout ratio is how much does the firm pay in dividends versus how much they actually earn. So let's say, supposedly, a company is making $2 a year, $2 per share in earnings every single year. So they're making 50 cents a quarter. $2 a share. But their dividends that they're paying would be $1 a share per year. That's a 50% payout, meaning they're taking half of their money and they're rewarding the shareholders, and they're taking the other half, I'll call it paying bills or let's say, they're reinvesting into their company and so forth. All right, some other things to look at, these are some other things that I like to look at, would be, price to earnings ratio. If I look at the balance sheet, some people might be accountants, they might like to look at the current ratio and, other things that we talked about as well. So the dividend payout ratio in the last slide. You might want to look at, price to sales ratio, because that's not just price to earnings, but that would be just price to the revenue that they generated per share. I think after this slide, let's take a look at this one first, and then maybe we can take a little bit of a break, right? Because we're coming up on about an hour. But one of the things I wanted to tell you about is when you're looking at investing in stocks, I like to look at it for the very long term. We're focused on two things, profitability and profit growth, and we're looking at it for the long term. It's not a matter of I'm going to get in, I'm going to get rich quick, and I'm going to leave. You can get lucky, and that's fine. That's a trade, that is not an investment. Think about investing in your health. If you're going to go to the gym, what are you going to try and do? You're going to try to slowly lose weight. You're going to try to slowly develop muscle tone. And afterwards, you're going to be well on your way to being healthy. This is the same thing from, we can look at from stocks as well. So you don't want to just generate more revenue for the firm, but what we also want to be able to do is for firms, we also want to look at profitability. So that's something that I wanted you guys to keep in mind, is that when I'm looking at profitability and I'm looking at revenue, when I look at revenue, sure, a company can make a lot of money, but what if it mishandles it, mismanages it? They're not yielding any profits. I've seen that in firms. And they're not solid companies. And people voted with their feet and they've left. All right? So let's just look at any company that you like. Is there any particular company that you guys like? Any company you guys like? Netflix. All right, so let's take a look at Netflix. All right, let's take a look at Netflix. Let's see. Let me see if I can share. Alrighty, so let's take a look at Netflix. Netflix, here we go. Oh, I know the ticker symbol, but thank you, I appreciate that. All right, so here we are on Netflix, and we know it's a solid company, alrighty. If we look at, we can even look at just Yahoo Finance, for crying out loud. Just look at Yahoo Finance and we take a look at Netflix. We can find their balance sheet, we can find their income statement. Yes?
Yeah, sir.
We have a question.
Not everybody knows what you're looking at, so if we can let them know, think or see, or what you're looking.
That's what I'm showing. Can you see that?
Yeah, so we see that. What happens, some people, they never have seen.
Okay, that's fine, that's fine, that's fine. No, I'll just give you a little bit of background of what I look at. That's fine. So let's take a look at Netflix, somebody mentioned. Alrighty. Oh, don't tell me the Wi-Fi. Oh, it's probably because I'm using up too much bandwidth. Oh no. Yeah, well, I have it turned on, so Netflix. There we go. Let's try this again. Here we go. All right. So let's take a look. Let's look at some. If we just go to Yahoo Finance, this is a publicly traded firm, and things are going to be right there for us. So yes.
People are saying that the screen.
It's not on the screen. It should be okay. 1 second. How's that? Can you see it?
Yeah.
Okay, cool. All right. All right, so if we're looking at, let's take a look at your financials. All right, so let's look at the balance sheet. Let me take a look. This is for, if people would like to take a look. Look, they're generating a lot of, this is their income statement. Sorry. So on the income statement, all costs, all revenue, all that's going to be shown on the income statement. So this is what we're seeing here. All right, this is fine. Income, operating income or loss, here we are. We're seeing that it's generally growing because, again, we're going from 2015 to 2018. This is great. Year over year, they keep growing, 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 and growing. Okay, that's great. If we take a look at the balance sheet, okay, we've got current assets right here at just about $9.5 million. Alrighty, this is probably in terms of thousands. So that would be what, 969 million, I would say? Or would that be 9.69 billion? I was always bad with powers and exponents. But nonetheless, we take a...
Billions because they don't show the thousands.
Yes, so it's billions. Okay, thank you. So what we see here, we've got total assets, alrighty, and we've got total liabilities. Okay, that's great. So on the balance sheet, look, assets are things that they have, that they own, that they can get rid of. All right, so that's great. They look like they're pretty, you know, they're all right. Okay, from that perspective. Net tangible assets, well, I guess I don't really know what tangible assets Netflix could possibly have because they stream, right? It's not like they've got like bulldozers and tractors and things like that, right? So I really don't know. Maybe, I mean, that's all I could think of, but how many buildings could they have? Data centers, but data centers where? They don't have to be in Manhattan, right? Where we're here today.
What Netflix is doing with Amazon, they are buying Amazon space.
Yeah. So Amazon, I can see they've got a lot of assets, and Amazon has to have machines to like, you know, transport things. But I mean, like Netflix.
Warehouses?
Netflix has warehouses?
Well,
But they no longer do DVDs.
Well,
It's a separate firm.
Netflix is getting involved in you know, the media business.
Sure.
And all this.
Well, I mean, we wanted to make sure that we have an explanation of why the net tangible assets were negative. So tangible means what? Touch, right?
Yeah.
So you can't touch a stream.
Is that the case of a lot of the highly valued companies?
Probably.
Very few tangible assets,
Yes.
which makes it very challenging to figure out.
It makes it very risky because if you are a common shareholder and let's say the company does go bankrupt, well, what kind of assets are you entitled to, even if you're a common shareholder? You know, if you're, you know, if it's a construction.
Liquidation, you mean?
Well, yeah, when it comes to liquidation.
Yeah.
You know, you can't own the movies. The movies aren't yours.
No, they're
The
not.
movies aren't even Netflix, right? Maybe, you know.
But I guess that's where contracts come into play because they
Sure.
own the royalties on a lot of it,
Yes,
right?
they do.
Yeah.
They do. Now, some things they do make. Yes, I get that.
And
So-
does it beg the question of, are you buying the stock for what they have now and in the past, or are you really buying it?
it for the future.
Yeah,
That's-
what their assets will be in the future.
Yes, yes. So if I take a look, I can look at, I'm looking at dividends. Netflix does not pay dividends. That's not necessarily a bad thing because they're usually what kind of a company? They're a growth kind of company. Software assets are huge. Okay, yes. So softwares are not tangibles, and I think that's the issue. So, so tangible assets would be something like, you know, like a data center, for example, a building. That would be a hard asset that you can actually touch. So software would be something you really cannot touch. Alrighty. So we can look at a firm like that, and you know, if we want to take a look at just charts, just very basic charts. I mean, I can just show you something that I do from a psychological perspective. If this loads, here we go. Load an interactive chart. Here we go. Let's look at for the past year. All right. So here we go. Alrighty. So it's trying to break through here. It's not. All right. So if it goes above 364, then I believe it's going to probably take off to 381. But I don't know. Right. So past performance is no indication of future earnings. I see that there is some support all the way down here. I don't even know what these prices are, but there's support down here and there's resistance up here. And you can take a look all the way over here. It didn't break through this peak that's all the way back here from October 17th of 2018. All right, so if we're looking at that, that's a psychological or technical analysis that we can look at. Good.
Okay, Javed is here. That's Javed.
Hey everyone, how are you?
This is me, I guess you know. Munshi Bhuyan, and that's Zia. Everybody already know. Zia.
Yeah, you can listen to me.
Let's continue. And before you continue, just recap what so far what we have done.
All right.
That way, people who came in later,
Sure.
they can get some update.
All right. So in the last hour, what we were doing is we were talking about different stocks. Can you guys see me at least? Or so we talked about securities and what publicly traded securities are.
Are you sharing your desktop?
Not yet. Not
You
yet.
can put it up. Just put it
Okay.
up. People
All right. So we'll look at it. right? Here we go. So let's
Yeah, people
share.
are asking for slides.
Okay.
And here also we do not see it.
All right. So, can you see it now?
Yes, we can see it.
Okay. Oops. All right, let's go here. All right, we had stopped here, and we were talking about, in this past hour, we were talking about equities, the equities market, securities, talked about publicly traded securities, and dividends. What are they? What do they mean? And someone asked actually before we left was, how do you find out how much does, let's say, a firm like Amazon make from, from each stream? You can't find that from the charts. You have to look through their annual report, and you have to listen into their conference call. So usually they'll report earnings, they'll report some data, and they'll tell you from each division of their firm how much they made. You can only get that once a quarter, and you'll get that from an actual report, which you're entitled to if you're a shareholder. And if you're not, they usually report that anyway for the public. So the next day, if they beat their earnings expectations, if people expected them to make a certain amount of money and they made more, then the very next morning, what you'll probably see is you'll see that the share price will go up because it seems a little bit more attractive and the company is just on the rise. All righty. So the next
Investment in stocks. So that's different from trading.
totally different from trading.
Why a lot of people, I think that investment and trading are all the same thing. It's not. What's the real difference there?
So for me, it's the time horizon. So if you're looking to invest in something, you're looking to really stay in it for a long period of time. If you're looking to trade, it's all right. When you're looking to trade, like you got baseball cards, right?
Yeah, baseball cards.
All
Sure.
right. So
all the kids have.
I had baseball cards. Okay, fine.
We're both Jersey
That's
boys,
right.
so
Born
you
and
know.
raised. I was born and raised.
Who didn't have baseball cards,
Exactly.
right?
You're born here.
And garbage pail kids too.
Okay. Well, I was overseas at that.
Oh,
so I
okay,
missed out on
sorry.
that. So I've got a whole bunch of baseball cards. And what am I doing with them? Am I holding on to them for a long period of time? No, I bought a few of them, and I would want to get rid of them. I didn't want to hold them. I mean, I have like a, well, take a look. I've got some investments that are terrible in baseball cards. I've got a Mark McGwire rookie. All right.
That was a good one.
No, not after the steroid scandals for all those baseball players.
Sounds just like a stock.
Yes, exactly. I held it for an investment. I said, okay, I have two of his U.S. Olympic team rookie cards. All right. And
They sounded good at the time.
they were great at the time, but now what happened? The share price, if you will, if this were a stock, it has completely tumbled.
Ken Griffey Jr.
I don't have his, but I have the runner-up
Nice.
for Rookie of the Year. I have Kevin Moss, who played for the Yankees. So that, so there are those that are investments, and then there are those that are sometimes trades, So
You say it's time horizon?
time horizon. So some of my baseball cards, I would buy them, and then I would just go to a show and just say, all right, I'm going to unload them, like in a month's time or a week's time. Again, there's a liquidity issue. I couldn't really get
What's
rid of-
liquidity?
All right, so liquidity is how easy I can get in and out of something, right? So if I'm looking at stocks are a very, very liquid asset because as long as the markets are open, there's a bid price, there's an ask price. The bid price is the highest bidder. If you have shares and you want to get rid of them by any means necessary, you're going to sell it to the highest bidder. There will be a bid price when the market is open. So does she have a question?
It's almost like how easy you can get in and out, almost like, how quickly you have access to your money.
Exactly.
Is that liquidity?
That's liquidity.
That's
Exactly.
right.
If you go to a bank, yeah.
You got idea.
What's it called? Here's some water for you here. It's very liquid. I'll be able to drink it really quickly.
Moves like water, right? In and out of your account.
That's it. But
From your account to mine.
Exactly. Now, if I had an ice cube that I wanted it to melt, how long is that going to take?
Wow. That's not as liquid.
It's not as liquid, right? So, sorry, my chemical
Ice cube
engineering
example is a good example of liquidity.
The same thing, I think, then when you have the house, it's not liquid.
It's not liquid.
Kind of like an ice cube.
So it's like
Melting over time.
You can't get rid of it easily. You can't get rid of your baseball cards easily. I mean, ladies and gentlemen who are out here today, I mean, how many people really have baseball cards and are actually trading them? and
Not that liquid.
they're not liquid.
Now, how does liquidity tie into risk? I sometimes think that all of risk is liquidity for me.
How so?
Because if I can't get out, then I'm stuck. And
It's a big risk.
that's a huge risk for me because honestly, the way I look at risk is how can I get my money? How can I get my cash? How can I hold on to my cash?
So let me give you another example. I'm in some private equity deals.
Sure.
All right. Those private equity deals pay above 10% a year.
Sure.
All righty.
That's a lot.
That's a lot. But
You must be taking some risk.
I'm taking the risk.
There's no free lunch
There's
out
no
there.
free lunch. Is it liquid? Can I get that money right away? Sometimes tied up for 2 years.
Not as liquid as cash. Right?
No, it's not.
Or
That's
it
the
may
point.
be even your stock.
Exactly, in the stock market and get that money right out.
There's always someone to buy when you
Every
want to
time
sell.
the market is opened.
But
Right?
your private equity, there's not always a buyer.
Exactly. All right. How am I going to find that one person who wants to buy my stake in a privately held firm that nobody knows about? Remember that if it's a publicly traded firm, everybody knows about it. But if it's a privately traded firm, I mean, if I tell you one of my privately held firms that I'm involved with, who knows about it?
That's right.
Because it's private.
That's right.
So they're not getting money from the capital markets. They're getting it from myself and maybe a few others.
That begs a very interesting question because you're talking about stocks today.
Okay.
Now, you pulled up some information on Yahoo Finance. I saw that.
Mm-hmm.
And every company now, you don't have to actually get financial statements. You and I are a little bit old. We're old guys. People used to get financial statements mailed to them.
Yes, that is
Back in the
true.
day, right, when we started
Yes.
in this industry. Now anybody can pull up a financial statement for free on Edgar, SEC, right? So information's out there.
Yes.
But where I'm going with this is it's hard to get an edge in information in stocks because anytime something happens, it's automatically disseminated, especially with Reg FD and whatnot. But with private equity, there's usually an information advantage there because it's what you said by the name. It's not public, it's private.
Nobody knows.
Yeah. So you might be able to get more of a return.
Yes. Somebody has this question here. Why would you put money in private equity then? I mean, if you can put the money in stocks and take the same profits, right?
This guy should not have been online. He should have been in here. We would have thrown you right into the conversation.
That's fine.
Very good.
So that's a very good question. So why would you put it in private equity? Again, for the reward. All right. So I will tell you, I'm in 2 private equity deals that are local to me. So that also helps. So that kind of mitigates the risk. I know the people, they live around me. I know where they live.
That's important.
The tangible assets are around me,
Yes.
right? I can take possession of them if I really needed to. I really don't want to. I want them to earn.
It's easier to understand something if you can go visit it.
Visit it.
Go visit the manager in
Yes.
person.
Yes.
Then try to get information from a PDF online. It's very difficult.
So it really depends on your risk tolerance. So, Duane, that was a great question. So could you get the same profits? You could.
All about risk,
It's all
right?
about risk. I mean, look at the companies that you're investing in. They're publicly traded companies. You're competing with what? With a whole bunch of firms. All right. Goldman Sachs is also looking to buy those shares. JP Morgan's looking to buy those shares. Bank of America is looking to buy those shares. Citigroup. All of these are a lot bigger fish. And so the stock market itself is not a pond. It is an ocean.
It is.
Right? So you have all these bigger fish in there. So for me, this is personally for me, this may not be right for anyone else, but I like to be in private equity with people that I know and I trust.
Well, you know, that you brought up something very interesting. The question was, can you get the same profit? What I like to say often is, can I get the same risk?
Yeah.
Right? Because profits, you can always adjust up or down based on leverage, which
Sure.
is a discussion for another day. You can always bring your profits higher if you take more leverage, or you can bring them down if you have less leverage. But risk is something that is somewhat fixed. And it's defined by actually who's running the company largely. and what the company's assets are. So you brought up a very good point. Public stock, it's very hard to go to the CEO of Chevron and figure out what he's going to do with the tens of thousands of
Well, you got to hear him speak.
But I did, yeah.
That's a
discussion
anomaly there.
I'm in a different capacity here today, so that's something that we could discuss one-on-one.
Yeah.
But, you know, you can show up at a shareholders meeting, you can get access, you know, like they do in Wall Street, the movie.
Yeah.
Michael Douglas.
Yes, I remember that.
Anaconda Steel. It's a little harder nowadays. He owned a lot of shares. But Yasser actually invests in some private equities where he's in direct contact with the sponsor himself, with the manager of the project, the one who owns the project. And that helps get a picture of risk, I think.
Of course,
right?
of course.
Could you speak a little bit about kind of the lack of understanding of how management drives risk in a public company versus having a better understanding of that in a private company?
So
That kind of speaks almost directly to where we're sitting today.
So there are three private equity deals that I'm currently in. Two of them are very profitable. One of them is not. And ironically enough, the one that is not, I am not in touch with the managers as easily as I am with the other two. So at the end of the day, I'm really investing in the management. And that's true in publicly traded firms too.
Yes, you are. You are investing in the management. Why does the management get on an earnings call?
Yes.
Because they know you're investing in them.
So when I used to trade oil stocks, this was just to get in and out.
Mm-hmm.
Some oil stocks were really great.
Yeah.
And some of them were really poor, but yet the price of oil kept going up.
That's right.
So what does that tell me? It tells me that the management, there's something wrong in the management. The oil is the same. It's traded on the commodities market, same price you get. So there must be something wrong on the management side.
That's right.
So for me, when I'm investing in the private equity deals, I want to deal with the managers. Mm-hmm. And if the managers are not doing well, the good thing is that I also teach strategy outside. I'm not here in that capacity either, but it's nice that things that I've taught, competitive advantage, core competencies, things like that we've learned, in any MBA program.
That's right.
Yeah, I can look and see, are they lacking in that? If they're lacking, I can at least offer my advice.
Yeah.
Right? And if not, then when my contract is up with them, I'm going to pull out my stake and then I'll walk away. Thankfully, I haven't had to do that. And why is that? Because I believe in management.
That's right.
And the management I can actually physically be in touch with at almost any time that I'd like. Like if I want to give them a call now, I can text, the CEO of that private equity firm. Of course, it's not huge, but it's nice that they're there, right?
Yes.
So does that answer your question, Duan? I hope it did.
One other thing I'd bring up.
Awesome. Yes.
It does? Okay. One other thing I'd bring up, because you're on stocks,
mm-hmm.
and we talk about risk with stocks and management. Another thing is what drives risk in stocks. So when you think what moves companies, management is definitely a factor.
Sure.
And we both in business school. I went twice. You teach in the business school.
Yes.
One of the primary things taught in finance class is the capital asset pricing model.
Of course.
And beta, right?
Yeah, risk.
Beta, so risk. So really what you'll see is there's been a large school of thought in understanding stocks and risk, that a huge portion of the risk in stocks is beta, actually.
Yes.
And beta is, on a very simple level, and you will explain it better than I can, but it's how a stock moves in relation to the market.
So essentially, if I'm looking at the Dow Jones Industrial Average
exactly.
or the S&P 500, fine.
Which is the standard.
That is an index. So my beta, if I have a beta that is 2.0 for a stock, that tells me that it should move twice as fast as that index, as the S&P.
As the market.
As the market, if you will. So if the market is essentially the S&P 500 index, that moves at a rate of 1, then I'm looking at company ABC with a beta of 2, that means the risk is going to be what? it'll move twice as fast in either direction. So that means if the market goes up, it will also go up. It will go twice as fast, or twice as high, if you will. If the market goes down, then it will also conversely go down twice as much. So
that's most of the risk. There's been endless dissertations written on that most of an individual stock's risk is beta. And how do you get rid of a lot of that risk is diversify.
Of course. And there's also something else. Before I forget, so you can have, beta does not always have to be positive. Beta can be negative.
Yes.
So I want you guys to think about it in terms of, let's say, gold in the markets, right? If I'm looking at a gold mining stock. So if I'm looking at a gold mining stock, that's probably going to have a negative beta compared to the market. If the market is usually good, then traders are going to leave gold and put their money in the market. If the market is bad, then they're going to probably take that money out from the market and buy some gold. And
defensive stocks are very much that way.
Yeah, so and defensive stocks may not necessarily be 1.0.
Might not be negative, but they move less.
They move less, so that might be a 0.5 beta or something like that, right? Because they're kind of like going to move slowly. Now, if I can, I really want to talk about the different types of orders that you have. So the orders that you have, if you see on that slide, I've got, you guys can see that slide, right? The how to buy stocks and sell them. I want to make sure that I brought it back to here. Alrighty, cool. So I'm looking at
Oh, he's got him.
Yeah.
He's got the chat.
So if we look, we've got slobs over bliss. If we have, if I can, I want you, oh, thank you. I want you to consider this as the market price. The market price. And I'm going to say slob. Oh, no, sorry. Oh, that's what they sell limit. All right, that's part of slobs. All right, and this would be a buy stop. All right, so slobs, SLOBS, right, over bliss. This would be my buy limit order. Or all right, so we've got some stop orders here.
Guys, we can't see the board.
All right, let's see. Hold on. All right, let me move this up a little bit for you.
How about now?
Is it better?
Is it better? All righty.
Can you see it?
No, not really. Well, yeah, we
You know what?
barely.
Whiteboard on Zoom, right?
Yeah.
Is there a whiteboard
Yeah,
on
you
Zoom?
can go. You'll zoom.
Use
out.
the Zoom.
Let's write it here. So let's say this one's going to be a sell limit, okay, or buy stop over, here's your market price. All right, so I wanted you to think about slobs over bliss. If I have the quotient is the market price, that's what's separating my numerator from the denominator. So I've got slobs, the sell limit, or buy stop. Those kinds of orders will always be above the market price. Just keep that in mind. We're going to go over some examples in a moment. And on the bottom, I've got bliss. So bliss will be a buy limit or a sell stop. All right, so let's talk about these a little bit. You know, if ever I try to buy a stock and it's going on the up and up and up and up and up, you ever try to buy it and you're hoping that, well, first of all, when do you want to buy it? You want to buy it when it's on its way up, but you don't want to pay the most money for it now, do you? You'd like it to come down a little bit, all right? So you'd like it to retrace a little bit. So I'm watching it go up and up and up and up and up, but can it come right back down a little bit just so I can buy it and then watch it go up higher? Well, if I'm going to do that, I'm going to use a buy limit order, right? So let's say I have something that started trading at $10 and it went all the way up to 20. Well, I want a limit order. I want to say, okay, I want to buy it if it comes back down to, let's say, $14. That would be a limit order. If it comes back down to 14, my trade will get executed, right? So I don't know if you can see on that one or not, but here, let's take a look at, here. Let's see if I can share with you a Thinkorswim, just a basic chart.
So you're saying it goes up and down? What happened?
All right, so let's say if a company just goes up, up, and then I want to buy it if it comes down a little bit, but I don't think it will.
You want to buy it when it comes down?
Yeah, when it comes a little bit.
Because you want a bargain?
Yeah, I'd like to buy that bargain.
Okay.
But that's a buy, yeah, that's a buy limit order. All right? Okay. So that buy limit order, I'm sure everyone's familiar with that one, with the buy limit order. If I want to buy it, I will buy it below the market price. So let me share with you guys something else here. And let's see if you guys can see this. All right, this is a platform that I use. Can you guys see like a dark screen behind? All righty. Do you see that?
Give it a second, yeah.
Okay, because sometimes there's a lag.
Okay, we're on Thinkorswim.
Thinkorswim. All right, so look, I'm not going to show you everything about this because we could sit here probably till tomorrow. All right, and discuss about half of it. But let's just look at a chart of Netflix. All righty, so if I'm looking at Netflix, and this is Boeing, sorry. Let's look at Netflix.
This is Thinkorswim.
Yep, so this is what I use for trading, for TD Ameritrade.
Which broker? TD?
TD, yep. So if I'm going to take a look at, let's say,
maybe you want to close out the ladder because it's confusing.
Well, give me 1 second. Actually, I want to look at just this. Alrighty? I'm just going to look at this chart right here. Okay? If I'm watching, let's say, here, I watched Netflix go from about $359.50, and it went up. And let's say I put in a limit order of 360, meaning if it ever comes, if I've noticed that it's going up and up and up and up, right, over here, it's going up and up and up, and I have a limit order at 360. I want it to come back down to 360 to get a bargain.
Okay, that makes sense.
All right, does that make sense?
What's your delay on this? When you are showing the chart, is it like, what's the delay?
Oh yeah, you have a little bit of a delay.
Yeah, the duration
okay.
of
So
the
if you're
chart
moving
is
around the chart,
yeah.
they won't see it as fast.
Yeah.
Oh, okay, all right.
Just
So
also let
let's,
them
you know what I'll do?
Compensate.
Here, this is what I'll do for you guys, if I can.
Yeah, if you can draw and also just let them know if it's like, 2 hours chart you're looking at or 5 days
Here.
chart.
Period.
Period, yep. So that way they know when it's moving up. This is it happened 2 hours.
See what I have
5
highlighted there?
Yes.
All right, I just noticed, let's say if that was live, I would notice that, hey, Netflix is going up. And I want to say to myself, all right, if it comes right back down to $360, I would like to buy it. That would be my limit order right there. Now here's the problem with that limit order. What do you see then? Did you see it ever come back down to 360? Did anybody see it come back down to 360? And the answer is, well, what do we have? No, okay, all righty. So it never got back down to 360, so guess what? It went all the way up to $364.
You miss it.
You missed it, all right?
That limit order did not work
That
well.
limit order did not execute, and you missed out. Now, what you could have done, of course, is you could have bought a market order. And a market order tells you that, okay, well, the market is kind of closed now, but let's say $362, all right? There's a bid and there's an ask, all righty? The market is closed, but if I wanted to buy, if I was so desperate to get in, I would pay the market price.
Just to clarify, Asim Qureshi is asking, we're talking about stocks, not options, right?
Yeah, this is just all stocks.
Just stocks.
Yep.
And your chart is a 5-minute chart?
This is a 5-minute chart. That means each one of these bars represents action that happened in 5 minutes. So let me show you what this means. So usually, hopefully, there's sometimes some kind of error. But
Keep throwing stuff in the chats. We want to make it feel like you're sitting in the room with us.
Exactly.
Yes, sir. I know you're going so quick. If you can have people on the beginners to say, this is how I got this bigger screen. That way, if somebody tried to follow along with your video, that we'll share this recording later on, they can do on their own also.
Yeah, of course.
Explain that.
Sure. Yeah, we can.
Yeah.
This will be for you guys if you missed anything. Yeah,
5 minutes.
you'll have access to this afterwards, and you can always just like reach out in the chat as well.
The deeper you go into it, the more you realize what you don't know.
That's true.
Every 5 minutes of your talk could be a separate class in itself. Right? I mean, we should pick one thing. That could be an all-day class. Right?
Candlesticks.
Gotta handle candlesticks.
All right. So
The deeper we're getting into, the more you realize.
so let's just look at limit orders. So we noticed that we never got down. What's app or tool?
Yeah.
So this is called Thinkorswim, and again, it's through TD Ameritrade.
So how
again,
do you get it? Do I have to pay for it, yes?
No, actually, it's free if you have an account through TD Ameritrade.
So I don't have to pay anything.
No, and just full disclosure, if you use my name, I think I get like $50 or something like that. All right.
So why don't you, after the course, we'll share the link with your,
That's fine.
this way, when we share the recording, in the recording, you like, well, I would love to, at least we all who's going to take advantage of this course, please do, at least that's the minimum you can do. Just use the link he's going to provide us. That way, the $50 is nothing, but at least that we are not paying for his time. He's being generous to come
Oh, yeah, that's not an issue. Yeah, because you know what? Unfortunately, I'll tell you one thing. It's just that I see people, unfortunately, they've put money into the markets and it's gone. And I think there's like a general rule of thumb in that I think 90% of traders lose 90% of their funds within 90 days of trading. So I don't want that to happen to anyone really. And I'll tell you how I lost thousands of dollars on a stock based on not looking at the types of orders that we have. So you see that the buy limit did not happen. So we said that the buy limit, if we go back to sharing, if we share our presentation again, all right, if you saw that, again, we said that our buy limit was below and we never were able to get into Netflix because the price never got down to 360, all right? Our sell limit would be above, meaning like if we had actually bought it at whatever price, if we put in a price that says, let's say I want to sell my shares at 365. Well, you saw that the price only went all the way up to $364. So if this is what we showed before. Alrighty. So if we had a limit order to sell at 365, let's say hypothetically we did own shares and we wanted to sell them at 365, guess what? Would not have been executed. Exactly. So if that's the case, maybe I don't want to use limit orders. Maybe I want to use some kind of stop orders. So why would I use a stop order? If I believe, if I go back to Netflix and I think if I say to myself, all right, here it is, it's kind of like in a range at this point for a little while. And I'm saying to myself, if it goes above $362.50, maybe, just maybe, I should buy it. So my buy stop order would be when I want to enter. okay? When I want to enter. Yes, I can use it if I want to exit, but that's for selling short. We're not going to talk about selling short, at least in this case. But, excuse me, I might say to myself, if it's going to keep going through, I want to buy. I want to catch that wave. So that price will be above the market price. It's going up here, and I'm going to say to myself, if it gets above this price, get me in. Just get me in. Why? Because I have a feeling that it's going to keep going higher and higher and higher. And notice, it never came back down to 360, so we couldn't participate. So if I'm going to use a buy stop order, it'll go right through, and I can catch it and be in. I can also, so if we go back to here, if we look at, again, if we're looking at here, my sell limit we set is above, but my buy stop orders are also going to be above. And again, we're not going to talk about selling short when you first get in. We're just going to talk about just buying. If you bought something, if you want to get into something and you desperately want to get into it, you buy at the market price. If you believe that there's a wave, a trend that it's going to go through a certain price, and if it does, it's just going to keep going higher and higher and higher, then you would use a buy stop order. All right? Last but not least, you have the sell stop order. And that sell stop order tells you that, okay, I bought shares of a company. Let's say I bought Netflix at $362, okay? But if it goes back down, if it does go back down, then guess what? I want to get out. Let's say if I bought here at 362, and if it gets down to 361, get me out. That would be my sell stop or my stop loss. Does it get to 361? It gets below 361. So then I would have sold because I'm worried about it going down even lower. So can you help me understand where is a buy stop option here? So for example, let's
Yeah, sir.
Yes?
Sorry to interrupt you. So I was trying to use interactive brokers tool, and in there I cannot see the buy stop option. I was trying to send you a screenshot.
Okay.
But I don't know how to send the screenshot in Zoom chat.
That's fine. So here, let me just show you here. So if I want to...
So yeah, sir, if you can rephrase the question he's asking for.
So how does he actually enter in at a buy stop? Oh, man. So unfortunately, it's only showing buy limit orders because the market is closed. That stinks. Because it should
If
be...
you go under, go under.
I can see stop limit, trail limit, snap market, snap mid.
Yeah, usually it's, I think a stop limit order is when you want to get out. So if you're hemorrhaging and you're losing money, your stop limit would be when you want to get out.
Above the market?
That would actually be, no, your sell limit is always above. But if it's a stop limit, in that case, if it's a stop loss, if you will, right? So it's a sell stop.
Sell stop?
A sell stop. So it means just get me out of it. Stop the bleeding.
Okay.
So sell me out at that particular price.
Got it.
All right. Does that kind of answer your question? Because I'm not really familiar with Interactive Brokers as a platform.
Not quite. I mean, there's also one option in interactive brokers called as IBALGO, interactive brokers algorithm something.
Algorithms. All right. Now these are just traditional orders.
So sometimes there's algorithms that, you know, it's a little beyond the scope of what we're doing, but a lot of, when you're putting a lot of volume through the market, like you're a big fund, or you want to hide your trade, and you don't want to impact the price, especially if it's illiquid, going back to liquidity, right? So then if you want to get away from actually pushing the stock around, then you can use one of the algorithms that some of these brokers provide you, and they'll put the trades in a way that it won't impact the flow.
No, here it says as an explanation that this is this attempts to achieve the fastest fill at the lowest all-in price. So thinking of stop buy order, I couldn't find it here. It says stop limit, stop, and this particular ID algo that says it attempts to achieve the fastest fill at the lowest all-in price.
If that's the case, it would be the market price.
Okay. We can revisit it.
Yeah, I mean, we can look at it a little bit later on, and you can touch base with us privately on it, but it seems like if you want to get in all or nothing, fill or kill,
Yeah.
it would be at that
Seems
market
like a
price.
fill or kill.
Yeah, yeah, so it would seem it would be at the market price, but we can check it out maybe later on, maybe during the lunch hour or something like that.
Okay.
These are from people who do trading. Should investors also put a stop limit order? You know what? Yes, yes. Mushi, you have a question?
Yeah, this is a good discussion
Mhm.
on this. I know that you have a lot of sessions coming up. Let's make sure the people who is beginners, we can keep them on the same level. And moving forward, you can later on know, the people already know today is your first session and second session you're going to cover out of 12 sessions.
Sure.
So I know that we want to make sure it's great. Let's have the conversation going. But I have seen your material. You're covering going deep later on. So let's not lose who has no background.
Exactly.
Yeah.
Yeah, I mean, so this is again, thanks Mushi for that, for keeping us on track on that one. So it's really a basic information kind of session that we have here for you today. But I do see one question. It says there are more, these are more of people who do trading. Yeah, so that's what Javed had mentioned. And should investors also put a stop limit order? Yes, they should. So a sell limit order or a stop loss. So unfortunately, I didn't do that with one company, and I've lost thousands of dollars with them, mainly because I didn't put in a stop limit order. I just kept saying to myself, it's got to get to my limit order price, which was $15.55. You know where it got to?
Where?
$15.54.
Close.
Close, but no cigar. And guess what happened?
You didn't get in.
I didn't get out.
You didn't get out.
And guess where the price went down to?
Very low.
$1.38.
Oh, man. Did you sell calls?
I did, but that's another strategy. But aside from that,
Yeah,
because
you
I
didn't put a stop limit.
I didn't put a stop limit. And
Is
guess
it-
what I
Does
did?
it cost any money to put a stop?
No, it doesn't cost any money. And
What might you lose?
But what
There's
might
no
you
trade
lose is
lunch.
because it might actually go back up.
Yes.
Right?
Opportunity cost.
Yes. So these are things that you kind of have to think about for yourself. It says, given that there is a charge cost for each transaction, what is the lowest amount recommended to not lose money when it comes to trading? You shouldn't even care about your transaction. If you're in a bad situation, you want to get out.
Well, that's actually a good point, Yasser, is like a lot of people don't think of it as cleanly as you do. They think, I'm not going to do it because I have to pay every time I get out.
Yeah.
So they think that'll add up. And so it's penny wise, pound foolish, right?
Yes.
Do you want to save $7 on a trade when you could lose 70 or 700 or 7,000?
So that's
You know?
again, that's like Kahneman things,
Yes.
right? That we were talking about.
It's a good question.
It's a great
Because
question.
a lot of people lose a ton of money worrying about their
Commissions.
commissions.
Yes. So, am I touching something that's going to?
Yeah.
Well, I'm like right on the.
Do not move your chair. Do not move your
All right, let me move this chair because it's about to fall on this thing.
Oh,
All right, wait, there we go. All right.
thank you. Now you better.
All right, good. So, yeah, so you don't want to really focus on your commissions too much. You kind of want to get out of that situation. Because I've been there. And I like to look at, so for example, I think TD Ameritrade tells you that you can buy 5,000 shares for a fixed price. Hey, that's great. Yeah, you want to get those economies of scale, right? So just spread that fixed cost over 5,000 shares. And so what do you end up doing? You're buying like penny stocks because how many people can afford to buy 5,000 shares of, Amazon, right?
Yes.
So can't do it really. So
some people analyze like, am I going to, trade a lot, or am I going to wait till I lose a certain amount before I actually put
You
trades
should-
to it. That's what I'm reading his question.
Yeah, but you know, you should kind of put commissions out of your mind.
He's going to come by 2:30. Okay, I told Sammy not to have him come.
But we're just, yeah,
Okay.
hold on one second. Okay, so, I don't like to think about my commissions because if I'm in a burning house, I don't want to worry about getting like, I don't know, my special items or something like that. I just want to get out of the burning fire, right?
Yes.
So that's how I look at it with commissions. So
Okay.
commissions do add up, don't get me wrong. And that's a very valid question, but yeah, if you're doing this too frequently, you're probably going to get a break from your broker. You can always call your broker and you can say, listen, I've been taking so many trades. I'd like you to reduce my commissions per transaction. So does that answer your question, Awesome? Kind of, okay. Well, if you have a follow-up question, hopefully we can address it as well. All right, so what else do we have? So that's what I have with all the different types of orders that you have. All right, so you guys have those over there. So let's I think I have an example. Oops.
It kind of answers the question. So you got to keep coming to the sessions, it looks like,
Yeah.
to get more detail.
Why can't I move this away?
Really, that question also is answered through practice, right?
Yes.
Paying tuition. Because everybody has their own trade-offs that they decide.
Yeah, so
No
you know,
pun
when
intended.
people ask me, well, okay, if this seems like so risky, what should I do?
Yeah.
Let me put my money in the bank. And what do we know about putting the money in the bank? What does that do?
Putting money in the bank makes you lose every day because you're fighting inflation. And I've never lived in a world in my 43 years on this earth where there isn't any inflation.
Yes.
So if you're putting your money in the bank, you're guaranteed to lose because inflation guarantees that prices will continue
To
going.
rise. Yep.
So you will be a loser
You'll be
every
a slow
time.
loser,
A
but
slow
you will
loser.
lose.
It's like a slow boiling frog.
Yes.
You wake up one day and you're like, my money doesn't buy me much of anything it used to buy. So if you didn't keep up with inflation, then you've lost already. You might have the same exact amount of cash and a little bit more, but you bought exponentially less with that purchasing
Yes,
power,
that's true.
especially here in the Northeast.
So think about like, you know, a gallon of milk when you and I were growing up. How much does that cost? $1.99 maybe?
Less,
Probably less for a gallon. Yeah.
Yep.
But now, how much does it cost?
4 or 5.
$4 or $5.
Double.
All right. So
How about a can of soda?
a can of soda.
25 cents.
25 cents, yes. And now it's what, $1?
Easily $1.
All right, so that's...
$4 on the street in New York sometimes. It's
So-
territorial.
All right. So has your salary gone up 4 times?
No, not anywhere close.
If let's say, because we were kids, but let's say, did their salary go up by 4 times
No way.
to get that same can of soda? No. All right, so that's why keeping the money in the bank, that's why I always tell my investors and potential clients, just please, for the love of God, just keep that only as an emergency fund, but otherwise, if you can afford it, then make sure that you can invest it in other things.
Yeah.
Yeah. So any questions at this point? Sorry, I just realized we just went over 45 minutes and we're barely halfway through my slides, which is fine.
I mean, the deeper you get into it, the more you realize there's more to learn. I mean, how long have you been trading this, right?
Oh my goodness, I've been, trading or investing?
Investing?
38 years.
Okay, there you go.
So, yeah, I've invested essentially my entire life.
Yeah.
Since 6. So,
I'm not as long, but still, I'm learning every day.
yeah,
It's
absolutely.
been at least 20 years for me since
Sure.
high school.
Sure.
But I'm learning every day.
Oh, somebody just said that this one company is terrible. All right. Oh man. So let's. Oh, somebody else had a question. So let's take a look. It says, I lost a lot of money on a certain stock. E-Trade did not let me put limit orders since it was over the counter. But my greed did not stop. I got initial profits, so I got in a lot more using margin, or buying on market price. But then it dropped suddenly so fast, and by the time my orders got executed, I'd lost a lot. But then I came to know, same time, Fidelity was allowing limit orders for that, while E-Trade was not. All right.
Now,
OTC, we have that.
OTC, liquidity. We always come
we
back
talked
to
about
liquidity.
liquidity. So tell me
So what does
something.
OTC
What does
stand for?
OTC stand for? All right. What does OTC stand for? All right. Let's see. Somebody came in. Just put 5% trail stop loss. All right. We'll talk about trailing later on because there are some people who are completely beginners in here. All righty. So over the counter. So what does that mean, Dewan? You're right. It means over the counter. Tell me something about liquidity when it comes to it.
There's
no liquidity. Usually
you're over the counter.
You're over the counter. You're not on the floor of an exchange, if you will, right? So that, you know, even though computers do a lot of the trading, but there's no liquidity. As a matter of fact,
You literally got to find someone.
you have to, you usually call your broker, and your broker has to find someone who will buy your shares.
It's one step away from buy appointment.
Yes.
It's like you have to find somebody else who has those shares, like the old days, and literally give
Yes,
them.
I got to find someone. So it's not like it's not a liquid market. So, but you know what? You're still here and you learned. I mean, that's how we all learn.
Pay tuition to the market.
Yes, yes, you have to pay to the market for your losses. Because again, have you learned much when you win?
No, I learned very little. Actually, the wins are riskier than the losses to me because the wins sometimes give me the false impression that I'm doing something quote unquote right because I won. But when I really dissect it, maybe it had nothing to do with doing anything right. It just happened to do with other factors. So when I lose, I'm always forced to dissect psychologically what went wrong, quote unquote.
Sure.
And that learning or that learning event helps me build equity for the future.
Absolutely, absolutely. So
That's an asset.
of course, an intangible
An
one.
intangible asset, but one that is extremely
Of course,
valuable.
yes, yes. So on the next
Everything
slide.
ties back. Looks like.
What's that?
Everything ties back.
Of course.
So,
We had
a
a
lot of
question.
interaction going on.
It's great. Like it's not much, which means E-Trade did not have the person on the floor while Fidelity had. So Fidelity might have had someone, or they might have had more people who were willing to buy at a lower price. So if you were going to put in that sell stop, if you will, because you bought it at a particular price, and if you wanted to get out in desperation, if it got down to a certain price, that's your sell stop. Fidelity might have had those people, but E-Trade in your situation did not. So it's a harsh lesson, but you're still here, and that's not a bad thing.
Every broker is not the same in execution.
Yes, that is true.
Now remember, when you're, we call it the big boy trades.
Yeah.
So when you trade the big boy charts and you're a big boy trader, it means you're truly an investor. Honestly, at that point, you don't care too much about day-to-day execution, getting in or out quickly, because you're playing for the longer term.
Sure.
So it gives you the luxury not to worry too much about a couple of pennies here or there, getting in out when you need to, because you're playing for the longer term chart.
Absolutely, absolutely. So if I'm looking at, for example, if I look at, I can look at something here. Let's just put something up, share, think or swim. So let's take a look at a,
Give it a couple of seconds to come up.
yeah.
Okay, now at least you can see it, yes.
Alrighty. So again, this is Netflix. Let's look at something else. You guys got any other companies you guys want to look at? I mean, I just don't want you thinking that I'm just totally fixated on Netflix. So let's see if there's another company you guys want to look at. Bob, okay. All right, we're going to have some representative bias. All right.
Alibaba, NVIDIA.
All right, so, okay, Boeing. All right, so let's look at Baba because that was the first one that came through. So if I'm looking at BABA, if I'm looking at it from a complete, this is now, each one of these bars represents the action that happened in 1 week. So this is going back from October of, I'm sorry, this is going back to 2017, 2018, it's 2019. So if we just take a look at what's been going on, we see that maybe, all right, it's safely staying above $120, all right? That's what it seems like. Now, of course, some kind of news, something could happen, and of course, that could just completely break down the share price. But if we're just looking at this, and if we think it's just like a boat that's on the waters and it's just kind of moving around, it doesn't seem like it's going to go below $120, and it doesn't seem like it wants to go really above $200, all right? So if we're talking about buying them, if we're going to say to ourselves, okay, if we want to buy BABA right now, Alibaba, we might say to ourselves, okay, let's wait till it comes back down to maybe 165, and we could put a stop loss at 120, but we could put a limit order at all the way at 211. So if I can, I'm going to put some points here, if I can. Let's see. Let's put some. Let's put just this line here. So I'm going to say to myself, it's probably not going to go above here, and it's probably not going to go below here. I know those are kind of crudely drawn. So I can, if I'm looking to invest, I'm saying to myself, okay, I'll probably buy it on Monday and just wait, and hopefully it goes up to 200. But I'm kind of hoping that it never goes below 120. I probably wouldn't do it for this because the price is at 180. So there's only $20 upside, but there's $60 downside, right? So I don't want to really do that because that is not enough for me because there's just too much. I want to be able to take off for the races. So, you know, there's another course that I'm teaching that really looks at these charts and looks at behavioral patterns and psychology. So in that case, you know, maybe you don't want to buy at 180, but you might come and wait for a little retracement to maybe 160. Because then when you buy it at 160, if it goes all the way down to 120, that's a $40 loss. But if it goes back up to $200, that is a $40 profit. That's a better risk-reward ratio. All right, there's $40 up, $40 down. All righty, but like Javed was saying, you really don't care at this point about, you know, getting in and out in a day. I mean, this is a weekly chart, so maybe it will take a few weeks to get in. And remember at the very beginning, we said that stocks do not expire. Stocks do not expire. So if you're going to buy Alibaba, the only reason why stocks will expire is if they bankrupt.
That's right.
Right? Or if they get bought out.
Yes.
If they get bought out, usually the share price does what? Goes right through the roof.
And you own the stock of
And you own the stock.
acquiring company.
Yes.
So you keep going with the acquiring.
Yeah, exactly. So, so if I can, let's see, are there any other? Alrighty, well, I barely got through anything else, but I guess what we can, so we talked, let me just reiterate just on the different types of orders. And so again, we've got market orders, remember.
Are we looking at a chart or you have a slide?
I have,
Slide came up.
the slide came up?
The share.
Did the slide come up?
We're waiting for your slide though. It came up on yours, but we're waiting for it.
Okay.
So
Did it come up?
Not yet.
not yet.
Oh no.
While we
Now it is.
we see that how about we take another 5 minutes?
Well, let me finish this one,
Okay,
and then
finish this
afterwards, I want to get to something, you know, these are some examples you can take a look at for them, but these are the types of orders, just to kind of let you know that you've got market orders, you've got limit orders, and you've got some stop orders that we kind of talked about. And again, if we look again on this slide, we've got, again, slobs are over bliss. So that's something to just kind of keep in mind. Alrighty, so again, we have some kind of examples here on on the succeeding slides if you'd like to take a look at them. All right, so for these 3 slides, you can take a look at them and you can see when you would want to use one of those kinds of orders. Alrighty, at that point, let's take another break. Right. So it's 12:11.
Yeah, Tracy, let's let's 25. Let's make it 30. Go 30. So they say people want to go longer break, and
All right.
and we'll have a lunch break around in 45 minutes from our.
Okay, so why don't we let's take a 15-minute break, I guess.
Okay.
All right.
Okay.
15-minute break. So all right, 10, 15 minutes.
So 12:15
Let's go to 12:30. How's that?
12:30, exactly.
12:30, ladies and gentlemen. That sounds like a plan. And then we'll just come back here and then we'll talk about a little bit about rational and irrational. Hey, welcome back, everyone. You guys back in here with us? I wanted to talk about psychology. Somebody asked about how do you get out of something and how do you not fall in love.
That's the heart of everything.
Oh,
right?
yeah. So try not to be emotional. So what we've got here, so I'll talk also a little bit about, we'll talk a little bit about, whatchamacallit. We'll talk about fear and greed, and we'll also talk about, talk a little bit about options as well. All right, so we've got, thank you guys. I mean, you guys have been listening to me for about two hours.
Yeah, the longest session we've ever done.
That's awesome. I'm glad you guys are still in there. They're hanging in there. So, welcome back. Can you guys hear me? All right. If you guys can mute on your end, that'd be nice, unless you got a question. All right. Can you guys hear me just fine? All right. One person said yes. That's awesome. Okay.
Can you do a slideshow?
Sure. So let's put it as a slideshow here. All right. So let's talk about here, not falling in love. All righty. I want you to just think about this just for a moment. Think about any kind of relationship you've been in. I don't care if it was a relationship with somebody you had a crush on or if it was a relationship at work. With a boss, doesn't have to be personal, it could be a professional relationship. So if that relationship is not fruitful in, let's say, 3 months' time, and you're at your job, you tend to do what? You get a little jaded with your job, don't you? I mean,
Yes.
you want to get out.
Yeah,
right?
that's like 1.5 years for me.
All right, you're very patient, I'll tell you that
But
much.
this one, I've stuck it out. But 1.5 years in, I was bored.
You were bored.
But I stuck it out for 8.
So I was like that, right? I was at one job that I just said there's really little value that I can get. There seemed like a lot of upside potential at this one company I worked for, but I just did not see the value, and I just wanted to move
It happens
on.
to all of us.
Yeah, and I was young. I was maybe 23 or something, 24 years old, and I just said, all right, I'd like to move on, right? Wanted to cut that loss. Oh my God, when I got laid off, holy smokes, that was like the happiest day of my life. All right, because I wasn't going to do it myself.
Great.
It's like I should have put a stop loss order in and said, quit the job, get out. But, I was at home, and if I had quit my job, my dad probably would have, strung me up. What
are you doing?
It's like, no, you don't quit your job.
Responsibility.
It's so miserable working there that every single day I said to myself, dear God, I'm young, and if this is the end of my life, I have no problems with you taking me now, all right? Because God knows, the older I get, the more sins I'm going to commit. I said, I'm young. You're going to have mercy on me now, all right? Just take me now. So, I used to pray for death every single day. I used to go to that job. So it had little to no value for me, and I wanted to bounce. I wanted to bail so badly. So, and every day I used to say to myself, okay, it can't get any worse. And guess what would happen?
What would happen?
It got worse.
It does. It does.
And so we say this and we're joking, but believe me, this is the same thing that is true for stocks as well. Now that was a relationship I could have managed at this company.
Yep.
Right? So there was emotions, but I could still control it.
Yes.
Can you control the price of a share?
No.
No.
That's the whole point of the stock market.
You really can't.
No.
Alrighty, so if you really can't, and you say to yourself, okay, it's gone down, let me buy some more shares. It's gone down some more, let me buy some more shares. It can't go down any lower. Is that true?
Famous last
That's
words.
famous last words, all right? This ship cannot sink. And it
Just because you
does.
don't want it to doesn't make it happen.
Exactly. So that goes back to an original question that we had, how to get out, all right? So it's not going to bounce back. It might have a dead count bounce, right? So usually it starts at one price that you bought in, and guess what? It's gone down. And then you say, okay, I'm going to buy some more because it's going to go back up, all right? And it's going to go back up maybe to halfway of, like let's say if you bought it at 100 and it goes down to 50, you're going to buy more at 50 in the hopes that it goes back up to 75 to break even. It never gets to 75. It doesn't. It gets to like 62 and then
Right back
goes
down.
right back down to 40, So in that case, there's a quote that I got there for you guys from Sun Tzu.
Who is Sun Tzu?
Oh, who is Sun Tzu? So he was an amazing military strategist in 350 BC, was it? I think so.
3,000 years.
Well, it was definitely over 2,000.
2,000?
Yeah.
2,500, right?
Yeah, yep.
Yeah.
So I think it was 350 BC.
Okay,
so anyway, so he had a number of quotes. If you read the Art
He's
of War,
historically one of the best generals of all history.
Yes. So a lot of business schools use his quotes, and sometimes they
Investment
meet.
bankers
What's that?
love to keep his book on their shelves.
The
and
Art of
pretend
War.
like they're
Yeah.
in the trenches.
So if you guys want to pick up the book, The Art of War, I like the Tom Cleary
Sure.
translation.
Pick it up in any bookstore.
Yeah.
And they've like reprinted it so many times. It's like you get it for less than $10.
Yeah, I mean,
It's so cheap.
it's $5
$5
or less or something, yeah. So if you take a look at that quote that I have there, essentially it says you got to know yourself and you got to know the market. If you know yourself and you know the market, you don't have to worry about losing. I mean, you will lose. I mean, no general has won every single trade, right? I mean, they had to lose and they had to learn. It's the same thing.
What do you do when you're in a heated trade? Like,
I like to lift weights.
Yes, so tell us about that. Like, because sometimes you get too into your screen, right?
Yes.
And you really need to take a deep breath. What do you do to get out of your own head? What are some exercises?
So again, I want to be rational.
Yes.
I want to fall in love, and I say to myself, okay, I bought something. I've got my sell stop limit, my stop loss. If it goes down and I'm out, I'm out. And then if it goes up and it hits that price, I'm out. So what do? I don't want to sit there and watch and watch and
Yes.
watch.
Physically, what do you do?
I just,
You leave the screen.
I leave the screen. I go lift some weights.
You literally lift some weights.
That's exactly
You
what
have
I've got
dumbbells
dumbbells. I got
in the
220
room that you
pound.
trade in.
That's exactly it.
They're accessible. You
And
step away from the
I
screen.
step away from the screen. I'll go sometimes. I'll just cook myself some breakfast, or
Yes.
because I already have my orders set.
Yes.
Right?
It's so critical
It
not to
is.
get caught up in the emotion.
And that's it. That's my decision, right? If it gets to that. So for example, when you want to come sell a house,
Yep.
if you want to sell, again, we said you bought it for, let's say, $400,000, and if it gets up to $500,000, you're going to sell it.
Okay.
All right? Regardless. Just because it goes to $650,000, are you going to kick yourself in the,
No.
you
I'm happy with, I got what I wanted.
got what you wanted. That was it. So you're not falling in love. So I hope I addressed that question.
So we have like a buddy system.
That also helps too.
And we didn't invent that. Like every fund in the world does not only have one person doing everything.
No, it's always nice to have a group. So Javin and I usually, we bounce our ideas off of each other and we keep it objective. We don't fall in love with a particular position. So if I could have controlled my career back when I was 23, 24, that's something that was still within my hands, right? Within my control. I can't necessarily do that with stocks.
So 2 ways to kind of hack that is one, to have a portfolio manager and a trader, which every fund, whether it be Fidelity, Wellington, Vanguard, State Street, SAC, Renaissance, They all have a portfolio manager who decides what trade to do, but he doesn't actually execute the trade.
No.
Because he could psych himself out.
He doesn't want to look at the
He doesn't want
screens, he's not working.
to. He doesn't want to second guess.
Exactly.
He made his decision, and it's final.
That's
regardless of what's going on in the market. Then he hands it to his trader. And maybe sometimes he physically hands a piece of paper, like they used to do on the stock exchange. And he doesn't think about it. He doesn't even want it. No.
He doesn't want to.
If it got executed.
So I want to mention something like, I like to watch baseball when I was growing up. And maybe that's why I was probably primed for trading, because baseball is all about statistics. All about statistics, probabilities and statistics. And, of course you've seen Moneyball, right?
Yes.
And so Moneyball, of course that's based on a true story.
Yes.
It's based on numbers. And so what are you doing? You know that in a particular situation.
What is Moneyball?
So it's a movie.
What's it about?
Well, it's about, the Oakland Athletics, and pretty much you didn't have to swing for the fences to win, right? That's a huge probability of failure to try to swing and get a home run.
We're still learning that every day.
Sure.
Yeah, those who is not watching movie, at least you can Google it. You'll see that Moneyball, this movie made by Brad Pitt. He's one of the main actor of Brad Pitt. It's really a good movie, but that will show you at least some idea what Yasser is talking. So I wanted to have could make sure some other people just offline reached out to me to how long this class is going to be today, Yasser class. Since we started late, our intent was at 2 o'clock, Yasser will be done. We will still try to see if we can keep it 2 o'clock. Our highest is 2:30, and then we still have in the afternoon session that the Ali Tarek is going to do his real estate class. So same online session you can use. You do not need to have a separate 2 different sessions. And I know some of you may have some other things going on. If you do, you can always watch the recording later. But what I would recommend, at least watch first few minutes, at 2:30 till, let's say, 2:30 till 15 to half an hour, and we'll have the lunch break, we'll have a break for prayer, and all those breaks will give you time. This way, at least you can catch up. Okay, so that's what I want to make sure that people know.
That's fine.
And after that, we'll have not only Ali Tarek, we'll have someone else in the afternoon that. She's a real estate broker, not a license holder. So one of the things she's going to talk about, some people wanted to know, how can I get a real estate license? So she's going to explain, if those who is thinking to start a business and how to get license, you'll have that also expertise and access to that knowledge. Okay,
sweet, cool. All right, so it's about 12:45. I didn't know I was going to be going all the way to 2, but that's fine, as long as you guys aren't sick of hearing my voice.
The other thing I want to bring up, Yasser, is that what we're realizing from this class today, there's so much to know, right?
Of course.
And the deeper we get into it, the more we realize what we don't know. So the idea of a coach, I think, also helps with psychology, because it's like learning a sport. It's like learning a sport,
So, it's really important, because that coach keeps you objective.
Yes.
Right?
Exactly.
So,
can you learn to play
soccer?
Yeah, go ahead.
So,
Soccer.
I love soccer, right?
Please.
So, the whole world has played soccer.
Yes.
Okay.
For hundreds of years.
How did they learn how to play soccer?
I think did they get on the internet?
No, they went on Google, didn't they?
Did they learn it on YouTube?
Ball? I mean,
maybe they downloaded a couple of PDFs.
that's it, yeah. And then they started going and shooting on goals.
And they just watched a lot of videos, and then they played well.
So I mean, seriously,
Right?
I mean, this is. I mean, I had you. So when the first time I traded a futures contract, well, we can talk about futures at a later date. But the first time that I ever traded a futures contract, I had my coach, and I had Javed, who's sitting with me here today. He held my hand, if you will, remotely, because we were on the phone, but he told me, this is what you need to click on. This is how you get into position. This is how you get out. Do I need you for that anymore? No. So it's just somebody who kind of teaches you how to kick that soccer ball, right? Exactly. So it's not just a matter of just, all right, I've watched some videos, and that's great. Look, videos can help. You can read books, and all that is great, and you can trade on your own, and could lose thousands of dollars like I have. And you can make thousands of dollars, which thankfully I've also made as well. But it really helps to have someone. It doesn't have to be me, but it's somebody that you trust their opinion. So generally, we tend to seek advice from, unfortunately, friends and family. All right. I met Javed when I was in my 40s. I was 40 years old. And we talk every single day. But he was my coach, if you will. And in some ways, he'll admit it when he comes back, I'm his coach. But you can't always find that. And there are other people as well who've traded, let's say, stocks, or they've traded currencies or futures or commodities or whatever, and they need someone to kind of look at things objectively. That's why it's important to have a trading buddy, and that's why Javed mentioned some funds or at some places they have a portfolio manager who says, this is what I want to happen, or this is the position I want to get in, and I don't want to know anything else about that afterwards. All right? Because they know themselves and they know the markets, and so they don't want to be imperiled in battle. What you don't want to do is you don't want to keep chasing. You want to chase what everybody tells you. If everyone tells you to buy company ABC, chances are it's too late to buy company ABC. All right, I've seen that. I've seen it. Think about Bitcoin, for example. All right, can Bitcoin go back up? Sure, it can go. But once futures contracts were announced on it, it went all the way up to about $20,000. We all saw it, and then what happened? Well, everybody got in. Now that everybody got in, we all know what the price is now, right? So there's that kind of bias. So we don't want to fall in love with something. Because again, the market doesn't care. Bitcoin doesn't care what, that market, GDEX does not care what price I bought Bitcoins at. It's a market, that's all it is. So here's an exercise that the London Financial Times had at the bottom of the screen. And I want you guys to kind of put in a number. So I think we have about, we've got about 15 people in here. But if you can, I want to tell you that it's an example on irrational behavior. The London Financial Times, they ran this contest. They asked people to select a number between 0 and 100. 0 and 100. So think of a number between 0 and 100. You got it? All right. Now, the person who would win this contest would be the one who got closest to 2/3 of the average number. All right? So from you guys right now, you can just type in your numbers there if you want. But from 0 to 50, what number would you select? You can select 0, you can select 100, you can select 50, you can select whatever. Somebody said 7, someone said 63, 13. All right, let's get at least 5 if we can. If we can. So we've got 83 so far. Alrighty. All right, so we've got 55. Let's get one more. Let's see. Let's see if one more person can chime in. I think someone was cheating, but no. All right, 75. Okay, so let's take a look at that average. So we've got 70 plus 13 is 83, plus 55 is 138, plus 75. All right. The average of those 5 numbers is 42.6, and 2/3 of that is 28.4. All right, so let's say 28. If you notice, some of your answers, all of your answers were irrational, right? This is not to put you down. But what were the rules? The rules were to pick 2/3 of the average number that everybody has picked. Now, usually if I just specified, I want you to pick the average number that people will pick on a scale of 0 to 100, what number would that be? Any guesses? Just a plain, straight up average. From 0 to 100 would probably be what? 50, exactly, 50. So here's the thing now. That seems like a rational answer. But now the winner of this has to choose 2/3 of 50. So what is 2/3 of 50? About 34. So if you know that, if you know that everyone's going to select 50, and the winner is going to select 2/3 of 50, then the answer should be 34. Does everyone see that? Does everyone get that? Well, you can just put yes or no. If no, I'll go over it again. If yes, okay, cool. All right. So you see that now. But now if you know it's going to be 34, and you're thinking everyone else is going to pick 34, then that average is going to be 34. So 2/3 should be what? About what? 22? I can't do the math exactly in my head. Around 22. Does that make sense to you guys? All right. So we keep going down. Now, if I know that everyone else is going to select 22, then I'm going to look for 2/3 of that. If I'm going to look for 2/3 of that, then what am I going to select? About 14, and so forth. Excuse me. The rational answer is what? What number should you pick? 2/3 of that number should be what? Essentially what? It brings us all the way down to 1. But that's the rational answer. Unfortunately, the correct answer from this test was 13. That means the average was about 20. But why was it 20? Because there's irrational behavior. There's always irrational behavior in the markets. People will buy, for whatever reason. They got to buy it for whatever reason. It could be irrational or irrational decision-making thing that happens. So if you take a look at the numbers that were selected, we've got 55, 75, 50. Those numbers, according to this exercise, are irrational numbers, right?
Yep.
And that's what we see in the markets.
Yes.
Right? And that will always happen. So you want to what? Be rational. You want to make money off of those who will not be rational.
Yes.
Right? Some people have got to get in. Some people have got to get out. Some people will just, pick any stock and pay the market price for it. Fine. You want to say to yourself, all right, where's a good price to get in at? Where's a good price to get out at? Be it for profit or for a loss.
I'll just jump in.
Sure.
My favorite way to get past the irrationality or the irrationality in my own head is to read all of it in the markets. And you might have said it when I went out to get the lunch. But, one of the best ways to read greed and fear, everybody else's greed and fear, is to read the charts. And I love to read into people's irrationality because greed is irrational and so is fear, but it's completely wired into our DNA.
Sure.
I think a lot of it has to do with survival.
And even though computers are really dominating trading,
Go ahead.
who's programming those computers?
Other computers? No.
Oh yeah, other computers. Not yet.
Not yet.
Not yet.
It's
But even
people.
so, it's people,
It's people.
who program them. So people's irrationality or people's irrational behaviors have gone into programming these options.
I'll take it one step back. I mean, Dalio is one of our favorite people in terms of learning, and he's one of the people I really look up to.
Who is it?
Ray Dalio runs Bridgewater.
Which is?
Bridgewater is hands down the biggest hedge fund, and it's been the biggest hedge fund for most of my professional career. It started way back a couple of decades ago. It's $150 billion. That's billion with a B. There's no fund that even comes close. And Dalio, when he talks about, people's behavior, he said the markets and the economy is really not necessarily all this data that you're reading or the Fed. It boils down to transactions.
Yeah.
Everything, the widget in the economy is actually transactions. All money and money movement, securities, banks, dollars, it's all based on transactions. The reason that this ties back to exactly what you're talking about in terms of rationality and irrationality, we see irrationality for all these pieces of paper. I call them pieces of paper, stocks, bonds, futures, whatever they are. There's irrationality all the time on the bottom, which is everybody's transactions too.
Gotcha.
You know, so stocks are a great way, or options are a great way, or futures are a great way to play the irrationality on the bottom as well. Because every day we're going to make kind of irrational decisions.
I'll give you one. I'll give you one that
on our transactions.
I'll give you one that a lot of people can relate to.
And it doesn't have to be monetary transactions.
When did you buy your house?
I bought it in 2008.
2000. Nice.
Well, I thought it was going to be nice because the market had dropped a lot.
Yes.
But what we all learn as traders or buyers of anything is there could be a lot more drop coming after.
Which is fine. So you said to yourself, you weren't going to buy it in 2004, 5, 6, or 7.
And I also was dirt poor.
I was a doctoral student, so
I had no
non-tenured
money.
afterwards. I'm like, there's no way I'm going to buy something.
I had a ton of debt, student loan debt. That's what
Well, I was lucky. I had no debt, but I had absolutely no money.
My wife and I,
$1,000.
all we brought
That
to
was
the
it.
marriage was no assets, only student loan liability.
No
That's what we both contributed to our marriage.
terrible. That's awesome.
So digging our way out of debt for about 4 or 5 years, you know.
Well, which is great, you know, and you made it, and that's great that you're here. What I was going to say is that the irrational behaviors that I noticed, so many people kept buying homes. And people kept telling us, you gotta buy, you're throwing your money away in rent. Oh my goodness. Now, my wife and I, thankfully, we have a nice small little home, but it's ours, right? The person who bought it from us beforehand paid almost twice as much. Now, again, I'm no expert. Because there's a lot of static in the background. If you can
Somebody's
mute-
unmuted there? There you go.
Thank you. It was irrational for us to bond.
Yes.
There was just no way. I mean, I told my wife, I said, if we can't buy here, it's time for us to leave this market
Yes.
and go somewhere else. You don't have to keep trading the Northeast.
No.
I mean, you know, I can go to the Southwest.
Yes.
Right? I can leave the United States if I really needed
Yeah.
to, right? So I didn't have to fall in love with one stock.
Nope.
I don't have to fall in love with one area. I like being here. I like, most of my friends and family are here, but I can also go anywhere else on the planet.
Yes.
Right? Fine. So we bought our house in 2013.
There you go.
We were very, very blessed. Why? Because we were, and by the way, ladies and gentlemen, this is like the only investment that has never gone down in price.
There you go.
That's the only thing,
There you go.
right? But we waited. So a lot of people used to make fun of us that we were throwing our money away in rent. And we'll talk about that a little bit later on.
Maybe that was an option.
For us, that was what we did.
Because you bought time.
We bought time. And so we kept
You didn't
paying.
have to go through the loss that I did
No,
in my house.
no.
No, I didn't realize my loss.
Mhm.
It was unrealized loss.
Sure.
But I could have been down $50,000, $75,000 at one point on my house.
But
right
you
after
didn't
the
look
loss.
at it as a trade.
No,
You
it
looked
was
at
an
it as,
investment.
this is an investment, I'm gonna stay in it, and I'm gonna live here, I'm gonna raise my family here, and my kids here, and so
Yes.
forth, right? So it's a lot bigger, it's a different decision, if you will, as opposed to a trade.
Yes.
So for me, I said the same thing. I'm going to buy it here. It's in this town. I grew up in this town, and now the school system, and it was near the water, and that's what my wife and I wanted. We got allergies in New Jersey, so we don't want to be inland. So for us, the rational decision was to keep renting.
There you go.
And so people kept making fun of us, thinking that was an irrational decision. Why are you throwing your money away in rent? And I said, I would much rather throw an extra $400 a month in rent. So that was about $5,000 a year.
Sure.
All right, $5,000 a year I was throwing away in rent, if you will. And we did that for maybe, 5 years?
Yes.
Yeah, I finished my PhD in 2005. Say even 8 years. It was $40,000
Yeah.
that I threw away
Yeah.
in rent. But I saved over about $100,000, right?
By waiting.
By waiting, right?
There you go.
So in the grand scheme of things, I netted 60 grand.
Yes.
Which is okay. You know, I was happy with that. But again, it showed that I believed in my position.
Yes.
Right? And I stuck to it, and it was a rational decision. It wasn't like, yeah, no, I'm missing the boat or anything like that. I got to catch this wave and whatnot. No, I did my analysis, and this is what every one of you guys need to be able to do as well, is you do your own analysis, you do your own homework, you do your own due diligence, and you take the trade. You make that decision, and you execute.
Yes.
And we live with it. And thankfully, we were blessed on it. It could have gone just the other way.
It could have.
Mushi has a
Mushi
question.
has a point. Go ahead, Mushi.
I can share one this
Go for it,
exercise. Let's say I have a real estate one. Remember I told you a story about me losing a lot of money.
Sure, earlier on today,
So
yes.
one of the best thing I have done back then is just putting money in the real estate.
Okay.
So many real estate, and I have been doing it before, part of the flipping.
Mhm.
And I've invested like jam model with people. But before jam model, there were people I know that, I have a trust with them. So I started giving them money, and just while I was doing all the other things, I had no idea how real estate worked. But that's one of the bucket I used. So one of the property I bought in Jersey City, that before September 11, 2001 happened, back then in Jersey City, you could buy land for 5,000,
Oh, I
10,000,
remember.
right?
Yeah.
So I remember I bought a property. It cost me around 95 to 100 grand.
Sure.
And as soon as I sold, I closed the deal. Within 2 weeks, I had a very good offer on the table to sell the land. I said, no, this is right next to the train station. So my dream house, when you talk about here, fall in love,
Yeah.
I fell in love with that place because from my house to Manhattan, 20 minutes.
Okay.
Train is right.
Beautiful.
Train is like about 15 feet to 20 feet away from my house. So you get out.
So that can get noisy.
Yes, it does.
Convenient, but it can get noisy.
But same time, I thought I'm going to, since I live so close to the Jersey City and Manhattan, my office was in 46th floor in Tower 1.
Okay.
So, from Wall Trade, I'm there 15 minutes, I'm at home.
Yeah.
From back to this.
We're glad to have you here.
Yes. The fall in love part, I want to tell you, that time I was thinking to all by myself live there, but then the good thing that I made is somebody gave me a suggestion. So why don't, since you are living on a property, very commercial, why don't you have a multiple floor?
Okay.
So what I did, instead of single family house, I created 3-family house.
Sure.
So I lived on the top, and I had first floor, second floor. So then by the time I was done with that house, that I was looking, the amount of money I invested and being there, that now that I know, sometimes you do not know what you do not know, right? So now I'm looking at the money I invested. I wish I would not put that much money in the real estate. I could leverage. I think that's something I know.
So that's something we'll talk about.
You can talk about later how to leverage.
Yeah, of
but
course.
as I am right now doing investment, I'm letting people know, do not fall in love, look at your numbers.
Of course.
But the amount of money I did, if I could use the leverage, and with the leverage, I could come out with zero, and I could have over $1 million.
Sure.
I could have now.
Yeah, that's a completely
But
separate
sometimes
conversation,
people-
but you're right. You don't want to fall in love, or else you would have spent so much on it. Absolutely. So I hope that you took that away from this slide, and I hope that actually helps you in the sense that you don't want to you don't want to be you don't want to escalate your commitment level to a particular decision. So even for myself, my wife and I looked at it as we were only going to buy one house. We weren't going to buy like a whole block, something like that. We weren't going to escalate our commitment level, so we wanted to hedge our risks in that regard. So enough on that one. I kind of want to talk about options. Somebody wanted to know about how do they use options? How could they use options? This is a whole class, by the way, so there's no way you're going to understand everything that I talk about today. I will tell you that right now, because options are probably I've mentioned this before. I've said that options are the hardest money that you will easily ever make in your life, meaning that you really have to push a lot on a rock before you get it moving. Alrighty, so there's a lot of effort that comes into learning options. You can learn it. I do teach it. That's not an issue. The issue is then you have to put it in practice. You have to use it. And you know, there was one trade I just took this past week. I was very blessed with it, but I could have easily, first of all, there was no way I was going to recommend this trade to anyone, but I was able to manage it. I used my decision-making abilities, right? So I did not fall in love with the position. I used my options trading strategy abilities, right? And I looked at the stock itself. So I was able to be profitable from it, but I was very, very blessed in being profitable on it. Why? Because I knew my psychology. I knew not to fall in love, and I wanted to be rational about it. So let's talk about options. Let's look at this slide over here. You can see the slide. I'm back on that slide of options. What is it? Alrighty. Can you explain what an option is for those who have no idea? Well, you have it right there then. So an option. What is an option? An act of choosing or an alternative to a choice of an action. All right. So the power or the right, but not the obligation to choose. All right. So something that can be chosen. Let me give you some. So if you're going to go to a movie, you go to the movies, you buy a ticket. You bought an option to go see whatever movie. Do you have to exercise that option? You don't have to go to the movies, do you?
Yep.
No, you don't have to. But you have the obligation, you have the right, but not necessarily the obligation. The movie theater, on the other hand, has the obligation to what? To provide you with film, right, for 2 hours. So that is what an option is. So we do the same thing when it comes to trading. You know, stocks have the same thing. You have the right to buy the stock at a particular price, but you don't necessarily have the obligation. So I'll give you an example. If we're looking at a company, the company's trading at $50 a share. We think it's going to go to $70. Well, you can't afford to pay $50 a share. What you can do is you can afford to buy the right to pay $60 a share for it. Now, why would you do that? Well, because the chances of it going to 60 may not be necessarily very high. It's currently at 50. So for it to go to 60, that's a push. For some bizarre reason, you believe it's going to go to not just to 60, but through 60 all the way up to 70. So what do? You buy something called a call option. Buy an option gives you the right but not the obligation to buy shares at $60 in the hopes that if it goes to 70 or 75 or 80 or 90, you bought a movie ticket, if you will, for shares at $60 a piece as opposed to 70 or 80 or 95 or whatever the price is. Right? So that is what a call option is. So you have the right, but you don't have the obligation. But here's the thing, just like the movie ticket you bought for that show that is for that day at that particular time, if you don't use it, what happens to that option? It expires. The same thing with options. So Javin, welcome back. We're talking about options. We just started talking about options. So, what time is it before I forget? It's 1:07. Okay, cool. So we'll wrap it up with options at least. All right, so let's take a look at some of these things. Call options and put options. This is the way I like to think about call options. If you're just going to go long and you're just going to buy, if you're going to go long, it means you're going to buy and you believe that the price is going to appreciate. It's going to appreciate. You have the right to buy at a certain price. All right, so again, $60 for that previous example. Again, we believe that it's going to go up through 60 all the way up to 70. However, the current price is at 50. So now the strike price is the price that you're going to execute at. So the $60 would be your strike price. Right? So you buy the right to buy shares at $60. So,
Why would I want to buy that right?
because you think it's going to go to 70 or 80, but you can't afford to buy 100 shares at 50 right now.
It's like you're getting a discount, but
A
you paid
huge
for the
discount, but you're paying for that discount. So people say that options are risky. Yes, if you're buying them, they are risky because, like we mentioned earlier, just like that movie ticket, it expires. Options can expire. What did we say earlier? Do stocks ever expire?
No.
No, only unless they go bankrupt or they get bought out by another company.
So stocks are forever, so you're paying more.
Essentially, yeah.
Options are limited
Limited time.
so you're paying less.
You're paying less for it.
Is it a lot less? Depends.
Well, you're paying a lot less, but here's the thing, the likelihood of you losing money on it
It's a lot higher.
is a lot higher.
No free lunch.
Nothing. So someone asked, well, why do you do this? Again, you have to, oh my goodness, have you found anything that has no risk but high reward?
Never.
Never.
If you find me one,
Yeah, you can give me a call.
I'll empty my wallet now.
I'll mortgage my
give you
house,
everything
and I'll give you
I own.
everything that I ever have made in my lifetime. So that's the point. You're never going to find something that is going to work all the time. And that's why it's very important to diversify and to at least be exposed to several different asset classes, right? Then you figure out, okay, this has been working for me. Right? I'm going to stick with it. Stocks used to work for me. And then I said, I don't want to follow these stocks. I don't want to, read up on news about the companies all the time and follow earnings. And then I said, okay, currencies are the way to go. Currencies were it for a while. And then, we saw what happened with the Swiss franc a few years ago. And I just said, you know what? I don't want to do this. Thankfully, I didn't lose on that one. But nonetheless, you could read up on it. But anyway, the issue was, I said, okay, I don't want to be in it. And then I met you, and then we traded futures for a little while. And then I said, okay, well, what did I do? I made money, but then I lost it. Lost some more. And then brought it back to life. Lost it again, brought it back to life. And the third time, said, all right, Javid, you told me we're going to use options and make it, and brought it back. And we did bring it back to life.
We did, and I'll jump in there, in that the way I like to think about options is that when I'm naked in a stock, long or short, I'm exposed to whatever the market wants to do, whatever that stock wants to do. However, when I am selling options, I feel like a landlord, because I am renting out that stock when I sell an option. I own the stock, but I'm renting out to a tenant some time within that stock. That's why I love options. Honestly, I don't really trade anything naked very much at all anymore, because why should I take that risk when I don't have to? I'd much rather take the kind of risk that a landlord does when he owns something and rents time in it, because if there's any certainty in life, it's that time will continue to pass by. We'll always be exposed to time. That's a certainty. There's very little certainties in life, but time will pass. As this whole session today went by, we went through a couple of hours on the weekend, so it was guaranteed that this time would pass. Options let us monetize the fact that time is always going by. Landlords are monetizing the fact that tenants will want to spend time in their places.
So that would be like selling options.
That's selling, and I'm only a seller.
Yeah, so let's talk about just buying it first, all righty? Which is what I do. I do the same thing as you do. I like to sell options.
Okay.
But we'll get to that in a moment. So let's say if we look at those scenarios that we have there, company ABC is trading at $30 a share, and you think it'll go up to 50.
Sure.
All right, so now if I'm looking at that, you can buy the right to purchase shares at $30 today if you think so. And if it goes up through to $50 down the road, that's great. You can buy the shares at $30 and then turn around and sell them right immediately at $50. So yeah, you pay a little premium to buy that call option. Think about calling up, I don't know, some of these people are young, they don't really know how to call someone up on a phone. But, but I like.
Does anybody do that anymore?
I don't know, but I like to know about. So a call option would be to call up. If you're going to buy that call option, you're believing that the price is going to go up. And a put option would be the right to sell your shares at a certain price. So let's say if you do buy shares, every time I used to buy shares, and I now realize why this is, but generally speaking, anytime I would put in an order to buy shares of a stock, there was a 100% chance that it would go in which direction?
The other way.
Down!
Down.
I realized why. There's algos and all that. I saw a whole documentary on that. But nonetheless, it would go down.
Yes.
So if I bought company ABC or whatever at $50,
yes,
and it goes down to 48, oh man. Well, what I might want to do is I might want to buy a put option.
Yep.
So that put option is like insurance, if you will.
Yes.
So how far can the price go? The price can go down to zero.
Yes, it can.
Right? I mean, again, I told you guys about a huge loss I took from, I was off by a penny from $15.55, went all the way down to $1.38. Well, you know, had I purchased a put option at, let's say, $15, I would not have lost
No, you wouldn't have.
all that money.
No.
Flushed all the way down like a toilet flushes. It just flushed down. $2.38. It was awful, you know? But that's okay. You live and learn.
Or you could have sold a call.
Or I could have sold a call. Well, yeah, but that's another strategy. So company ABC here in scenario 2 is trading at $30, and you believe that it will go down to 20. So what you can do is you can buy the right to sell your shares at $30 because you're just worried. So that if it does go down to $20 down the road, you can sell them at 30. Heck, it doesn't have to be $20 a share. It could be, you know, $25, $27. You still have the right to sell your shares at $30 if you bought that put option. Alrighty? How are we doing so far? So did I answer?
Questions.
Well, I saw Fizzle ask if I could explain what options are. So I kind of hope that I was able to do that before we kind of move on.
It's a whole separate class.
It is.
Because you wrote, for those who have no idea, you're not alone, or people in this room are not alone. Most people,
90% of people,
I would say, if you ran statistics, almost everyone has no idea what options are. And that's why we're just going to do a whole session on it, but honestly, it's not enough. You really have to keep trying and getting coached, because it's a derivative and it's not intuitive to understand. But once you do, the kind of control or calibration that you have around your positions is almost unlimited in terms of how much you want to dial it in or dial it out. So all the kind of being a slave to the market and being exposed to whatever the market does, you can really take a lot of that out through options and exert a lot more control about what your risk reward is that you want to take.
Absolutely, absolutely. So if we take a look at what Javin was talking about, selling options, you know, when I'm looking at a range, if I'm looking at a company, I'll say to myself, there's about a 90% chance that the price will stay in between two different prices. So, you know, I do this with some of my students too. Well, I like to sell options on crude oil futures. It's not a stock, but you could. I guess there are some funds that mimic the price of oil. That's fine. But I like to sell either calls or sell puts. So somebody believes that somebody believes that the price of oil will go up, and I'll take the other side. I'll be the movie theater. I'll say, no, it's not going to go up to that price. So I will sell you. I will sell you that ticket. So if you take a look at scenario 3, I'm looking at expiration, and I'm saying, all right, oil will never get above $61 a barrel. So I'll decide, hypothetically, to sell someone the right to buy barrels of oil at 61. They believe it's going to go through the roof. It's going to go through $61. They're going to pay me a premium. Let's say they pay me a premium of $300, $320. If it expires less than 61, I get to keep that $320. Unfortunately, like we always say, there's no free lunch, because if the price goes up to 70 or 80 or 90, they have the right to buy barrels of oil off of me for $61. Yes. So I have to go in the market and pay $70 or $80 or $90 and buy those barrels and sell them back to that person for $61. That's how logistically it happens, right?
That's right. And remember, I mean, I'll just add one thing there. There are two types of people in the market. There are hedgers and there are speculators, especially in the crude market. So a lot of times you will find somebody on the other side just because they have a different motivation than you. They might, going back to your original example of Chevron, they might be in Chevron. Now, you don't own oil, but Chevron owns oil all the time. And Chevron's not in the business of guessing the oil price. They're in the business of creating value for their shareholders.
Of course.
Which means selling oil, period. Because
Absolutely.
they have oil and it needs to be sold.
Sold.
You know, so you can make a lot of money off the fact that Chevron is very willing to give up the 70, 80, 90, $100 of oil every day.
Sure.
Because they need to sell oil,
Yes.
not sell oil at a certain price. Goes back to what Dalio said. Everybody's taking a transaction,
Of course.
right?
Yep.
And they have different motivations. Doesn't mean Chevron's not going to make a ton of money.
No.
Just because they didn't make the price that's in the market.
That's okay. That's okay.
Because their cost might be very low.
Very low. It probably costs them whatever, $25 to get the barrel.
It doesn't mean that you can't make money
Yeah.
in the same week as Chevron,
As Chevron does. So
at different prices.
So I make, let's say, 1/10 of
Yes.
what, if you're trading.
Maybe
oil.
1 millionth of what Chevron
Oh,
will make.
well, no, I was going to say per contract.
Oh, okay, yeah.
So for example, if we look at, let's say, a stock will go up or down, you get to reap those rewards.
Yes.
If it goes up or down. But what I'll do is, okay, if it's trading at $50 and I've got 2 weeks on an option to expire, like that movie ticket's going to expire in 2 hours, I'm going to sell that option that's going to expire in 2 weeks.
Yep.
And what happens is, okay, if it's around $50, I'm going to say to myself, it's probably never going to get to 60 or 61 just to be safe. All right, watch yourself, you're about to trip over something. So at 61, so what I'll do is I'll sell that call option. Somebody has the right now to buy barrels at 61. And over 2 weeks, I'll sit there and I'll sweat bullets and see, you know what I mean? And see, sometimes, it gets to like 58 and I'm like, is it going to get to 61 or not?
Yes.
Right? But all the while, every day that it doesn't get to 61, that $320 that they paid me now becomes 310.
Yes. And what about the weekends are the best?
Yeah, the weekends are
Not
the best.
only because you
Guess
don't have to
what?
work.
So people ask me all the time, they're like, so you mean there's time decay even on weekends? I'm like, yes, because that option expires on a particular date. Doesn't matter if the weekends are going to pass.
Weekend is still time,
It's still
Dalio.
time. It's still
It's
time.
not like time stops.
So-
Now, for some people, time stops at the weekend.
not
But not in the market.
Not in the market. So here's the beautiful thing. So think about it this way. So how many people just think about, all right, if you're going to rent out an apartment, when you rent out an apartment, you're going to rent it out for, let's say, $2,000 a month, right? Okay. And by the 30th or the 31st, you're going to get ready to get another 2,000.
Yes.
Right? Doesn't matter that the weekends pass or not.
No.
You just gotten that 2,000. But what are you hoping for? You're hoping for good tenants.
Yes.
Tenants that aren't going to ruin your whole entire apartment, right? Tenants that aren't going to throw wild parties and break windows or appliances and so
Yes.
forth. Now, you've capped your profit at $2,000.
Yes.
Your risk is unlimited because they can burn the whole apartment down,
Yes.
right? So, but you're happy collecting $2,000
Yes.
a month. That's what we're doing here in call options.
That's right.
So, all right, so I'm selling my option every single month on oil, for example. I'm saying to myself, okay, I want to collect this $320. All righty? If a fire doesn't happen, so to speak,
Yes.
right, I should be okay to collect my $320. If it does, then I gotta go in and suffer the loss, if you will, just like a landlord.
Or time. Because if you're covered,
Okay,
you
so
don't
that-
have to suffer your loss.
Yeah, exactly. So that's
Which
a
is
covered
like
call.
600
Well, so-
level.
Yeah, so I have an example on that one. So what
Actually,
happened-
the most basic option
Is the
position
covered
that
call.
everybody should start with, right?
Yes. The covered
Nobody should
call-
do anything. When you get approved at TD Ameritrade, you should
Sure,
only
or
get
wherever it
approved
is,
for covered
for
calls
covered
first.
calls.
First.
So the reason why, so Java mentioned a covered call strategy.
Beginner level.
It's a
of
very
options.
beginning level. So a covered call strategy is when you own the shares. So if I sell this call option and I believe that it's going to go, if it's going to stay below 61, but it goes all the way to 90 or infinity, I'm considered naked because I'm totally exposed, right? But a covered call is when you actually own the shares.
Yes.
So when you own the shares, you'll say to yourself, okay, I'm going to sell at $61 a share, hypothetically, but I bought it at 50. Somebody has the right to buy my shares off of me at 61. Are you upset if it goes to 70?
I made a ton of money
Going
going
to
from
61,
50 to 61.
Fine, you're
We
happy.
all won.
We all won. So you won, and now that other person has the right to buy your or will buy those shares off if you had 61, because now it's all the way up to 70.
So he made money
So he-
61 to
she made
70.
money,
She made money up
whatever.
there.
You made money.
I made
from
up to 60.
61.
We all made
You
money.
all made money, right? So that's a nice way to start off with options, because a lot of people understand now you guys know how to buy shares.
I'll just jump in here.
Sure.
It goes back to forever stock, options are limited time. So going back to the 50 to 61, let's say it went down to 45 or 40.
Okay.
Now, my stock is forever.
Yes.
The option expired worthless, which
Yes.
covered some of the loss.
Yes.
Now,
It's
I
true.
don't have to give up that stock.
No,
and
you don't.
realize any
No, because
loss.
it's down to 40.
Yes,
All right, so you can do this again next month.
and sell
right? And you
again.
can sell again.
So that's the great thing about owning
options.
stock
So
too.
this is beautiful if you do own the shares of stock. So
Yeah.
let's say if you do buy it on something that does pay a nice dividend,
Yes.
right? So
You're getting paid with the
you're getting paid with
dividend.
and then you're saying to yourself, what target price would I want to get out at?
Yes.
So let's say if I bought it at $100 a share and I would get out at 125.
Yes.
But every month, every year they give me 4%.
Right.
So I put, let's say, $10,000 away. Every year I'll get $400 worth of dividends,
Yes.
$100 a quarter. That's great. And I can sell, 12 months out for
Yes.
that option. All right, at $125.
That's right.
Gets to 125. I'm happy. I'm not going to cry if it goes up to $200 a share because my decision said, my thought process said, I want to get out at 125.
Yes.
And I have the shares in my back pocket.
Let's tie it back to risk.
Yeah.
So every time you're collecting that option premium
Yes.
or getting the dividend,
Mhm.
you're lowering your risk
Risk.
because your cost is going
Down, down, and down. So every year you're getting 4% every single year, and every year, depending on how far out you sell that option, options can go for a week, a month, a
year.
week, 2 weeks, 3 weeks, 4 weeks, months, a year,
2
couple
years.
years. Alrighty, and
There's
so,
less liquidity.
but yeah, there is less liquidity when it's 2 years out because nobody's really going to be in that.
Yes.
But let's say it's 6 months.
Yes. There's always 6-month options.
Yeah, so I'll do it for 6 months. I'll do that twice in a year, not a problem.
So you are saying an option has a tie into time, right?
Yes, absolutely.
You are not buying some asset. There is a time that you are
Mhm.
buying.
Yeah.
So now within that time, you can figure out with the strategy, you can figure out if you can capitalize whatever option you are.
Sure.
Or you're selling the option for somebody else to try to capitalize. If they don't, you're like a landlord. They lived in your stock for that time. You collected the cash for them being a tenant in your stock.
Absolutely.
Then they can go their merry way and you can go your way with collecting that deposit.
That's very good. Just on the options is selling the option.
Yes.
Mhm.
So some people, some of you may know that I'm in the business of like insurance.
There you go.
How so if you can explain to people that give an example, this time also part when you
Yes.
sell it, almost like selling
Premium.
insurance.
It's called a premium, by the
Yes.
way. It's called a premium.
So here's the thing. So let's give you another example. There's one question in the separate class. Well, we covered this with real examples too. Absolutely. The examples I use in that class, I always change them so that way they mimic what's happening in real time. So that answers your question, Duan. Thank you. So insurance, this is a beautiful thing.
Buffett made his money in insurance, by the way.
Yeah, okay, Geico, right?
Yeah, Geico.
Yes. So,
And that's one of the businesses he loves the most.
Why?
Out of all his businesses.
So here's the beauty about insurance. This is why I like to sell options, ladies and gentlemen. The probability of somebody, I know, I'm pretty close to it, we still have, okay, good. I want to make sure that I don't trip over these wires over here. But here's the beauty of selling insurance. If you look at yourself, like for example, I'm 24, I'm married, I got 2 kids, I've got a certain level of education, I've got a stable job and so forth. My car insurance, I haven't gotten into any accidents that were my fault, thank God for all that. What's my insurance rate going to be?
Low.
Pretty low, all right, it's pretty low. I got to pay it,
Yes.
all right? Every single year I pay it.
Yeah, every month.
Every month I pay it, right? And guess what? I'm losing.
Yes.
When's the only time that I can make money?
If you had an incident.
If I get into an
If you have a
accident.
claim.
Exactly, if I've got a claim, right? So the insurance company is saying to me, all right, Yasser, you idiots, I'm going to sell you insurance and you're going to pay that premium every single month, right? And that's okay. I'm not an idiot or anything like that. I got to have insurance because God forbid something happens, right?
Exactly.
So I'm happy to pay that monthly premium. And they're happy to do what? Collect that monthly premium. So again, they're the landlords, and that's why Buffett makes his billions off of insurance, right? Because he's selling that insurance every single month to him. But you know, the firm is selling insurance every single month to people who what? Who will not get into accidents. And guess what happens when that insurance, when that month expires? What have they done? They get to collect and keep the entire premium.
Exactly. Because there's a lot of people who come to me and say, I don't want to own a real estate house. I don't want to own a building because I can't deal with tenants. I can't do repairs. I can't collect rent, and I can't find a new tenant. Well, this is a way to be a landlord without having to deal with any of those issues. And sometimes you can be a landlord for less than what it costs to own a building or 10 houses.
Well, this is certainly a way to do it.
Yes.
That's definitely a way to do it. So that's what I like. Mushi has another question, another point.
So which is good. Like I wanted to emphasize to the people who is new and thinking about option. What we have seen, or what based on your experience, Javed experience, you know that those who is getting into in selling option usually safer than going into buying option.
Yes, that's a very good point. Let's emphasize that. We don't want to leave them.
We do not want to say, but those new people just do not get involved, and then you lose your money.
That's why they hear that options are so risky. Now, options are the riskiest thing you could ever do in your life. I will validate that statement. But they could also be the safest thing you ever do in your life as well.
So,
and that's why you got to know.
You got to know the probabilities.
The knowledge. So no, you got to have the knowledge of how to even use that.
So, for example, we start talking about deltas. Well, okay, for today, if you have no clue about options, you have no clue about delta. Unless you've studied chemistry with delta H for heat transfer coefficients. You have no clue about what deltas are, right? So
you got to start at the basics, like you're doing, and then build up from there, like a house, right?
Yeah. So you got to lay the foundation.
Foundation. That's what we're doing.
That's what we're trying to do here today.
And it takes time, right?
It does.
Nothing comes quick.
So you got to remember, at the beginning, this morning, what did we say? That it's a marathon.
It is. It's a journey, right?
It really is. It is not a sprint. You will not learn options overnight.
No, that is one thing you just can't. You can go buy a stock and sell a stock. It doesn't take much.
No.
You can even call a broker to do it for you.
Sure.
But options take time.
They take time because you got to understand what the probabilities mean. You got to understand.
Even you got to understand what does what.
Yes.
There's 4 scenarios. Buying, selling, and puts and calls. So you got to really have a feel for what those mean in terms of risk.
Absolutely.
But it doesn't mean that it's complicated.
No.
It just takes time.
It just takes time. All right.
It's actually pretty simple when you dial it down to the widgets and what it is.
Well, you just have to do it.
Yeah, and you got to do
Going to the gym is easy.
Yeah.
I'm sorry, working out is easy, but you just got to
get to the gym, right? Yeah.
Exactly. Once you get to the gym, and then you got to figure out, I can do these machines, and I start losing weight, and I start developing muscle tone, and my stamina is better, and my breathing is better, and all that. Well, that's great. That's what options are.
Yes.
All right. So,
you just brought up 2 things. Just want to make sure a lot of the time people, when they're going to the gym, it's the environment. The environment is the one, right? In the gym is an environment. And once you have to surround yourself with the people with the like-minded. Like hardest part is going to the gym. And I know earlier you mentioned about the psychology that in the class. So those who is learn is just coming today, just thinking, okay, now Yasser is doing it today. Just keep that in mind that today you're getting foundation, like what Javed mentioned.
And you're getting an abridged version of
you want to make
foundation.
money and looking stock as one of the vehicle to give you the passive income. So you have to be surrounded here. Like today we are doing it online here. Most of you are online, but we will be in our next class is going to be in New Jersey. So remember, Plainsboro, New Jersey, that's the location we're going to be. So remember those, if you can come in, at least come in person. That way you not only impact yourself like the gym, what Yasser mentioned, you can interact, ask those questions in face.
Yes.
Right, face to face, and this way also you learn from the people who is doing it for living,
Yes.
right? And then you start helping each other, build that chemistry. Surround yourself with the people who already has making money and still keep doing better and better. That's all I want.
We also have trading rooms, right, Mushi? Like Yasser and I actually, before we met you, Mushi, we used to run trading rooms before together, where people were actively trading. It takes a village, right?
And
you
it was,
need a
yeah.
team.
And it was
ahead.
so beautiful because, you know, Jav mentioned something about having a coach, having those kind of chat rooms with people. Who
And these
actually
were
know
virtual.
these
We
were
were all over
We
the
never met
country.
these people.
We weren't even in the same state.
No.
But we were trading at the same
time.
Yeah.
And, you know, there's money to be made for everyone. There was nobody saying that, okay, I will make it, but I will make it on the backs of you, or vice versa.
There's plenty of money to go around.
That was it. And it was so helpful, and it was such a positive atmosphere.
Yes.
So it's very important to be in that environment. Exactly what Mushi said as well.
Mushi runs a trading room now from the previous stock class that I presented at. There's a good number of people in there. So we'll hope to create a trading room with attendees. From
Sure.
Yes.
Yeah.
So yeah,
Virtual
people-
trading room.
Same way, like exactly. So that some of these students already are in this class.
Okay.
But some of them are already. The funny thing is just what Javed mentioned. Those students who got a value out of the past, our earlier batch class.
Yes.
They are the first one. Whenever we opened up this class for about a month ago or a couple of weeks ago, Yasser, if you remember, we had a lot of people showed up.
Sure.
They are the first one bought this. Most of you are getting it free, but at least they saw what value into it.
Okay, good.
And I wanted to have people just know that it's Yasser, Javed, you know, they don't make money of doing this. It's just like they are taking their time off from the family to coming in Manhattan to do this. And we have the location here, but we had people in the past in the class, they said, hey Mushi, why don't you do Manhattan, we'll come. But not everybody showed up.
Sure.
But we are in the business of not, oh, somebody didn't show up, let's not do it. We will keep doing it.
Yeah.
So just
The markets never close.
So-
yeah. And so we don't close either.
So next time, just remember yesterday you're going to let you know when he's going to do all those 10 classes. Sure. And just I want to make sure people know, and then we will have in person also. In person, our next class is going. I'll share the location, address, and all of those.
Okay, cool. Somebody said, thanks for the New Jersey location. That's great. So
We both live in New Jersey.
Yes, so that's fine too.
And those who is from Philly, we are also have a location right now. So next month we are going to come in Philly too. So our
Cheesesteaks.
Our plan is we are going to change. We are going to vary ourselves. So we'll come and we'll build a smaller community at each location, so you can surround yourself with like-minded people who wants to use the stock as another passive income source.
Great.
So, but know the tool before you start playing with the fire. Like
Of
what
course.
Yasser
Yeah,
was saying,
yeah.
option can be a fire, but if it can work in your benefit if you know how to use that fire.
Exactly. Exactly. There's no, I don't know anybody who's like a king of options or anything like
Me
that.
neither. Me neither.
And so, be
But you pick
careful.
up pennies in front of the steamroller,
Usually,
and then it adds up,
And
and
it
it
adds up.
compounds
yes,
over
yes.
time.
So, you know, all I do is I look at probabilities and I take a trade, right? Do you have an emergency fund? Do you have kids you want to marry off or put in college or whatever it is? There's so many different factors.
Yes.
Before I can suggest anything. And then somebody asks me, for example, you know, yeah, I think so. So what happens is I have to know about all these factors first. And if I know about all these factors, then afterwards I can tell you, okay, what are you going to buy? So I'll give you an example. We had a private equity deal, right? That we ran. What was it? Like July? This past summer. Yeah, it was this past summer. In the past summer. If you can just mute it, that would be great. So This person actually, he asks me for advice all the time, which is nice because I'm his investment coach.
Yes.
In the sense that he asked me, he said, well, Yasser, what should I do? I have $15,000. Should I put it in this investment or not? And I talked to him for about 2 hours about, his situation, and we went through from A to Z on whether or not he should do it. And at the very end, he still asked me, oh, would you do it? Like, it's not up to me,
Yes.
it's up to you, all right?
Exactly.
When I do it, I know I did it.
Yes.
But that's not, my situation is different than
That's a very good point.
right?
That's a very good point.
So
Because everybody has their own risk reward,
Exactly.
their own life
Tolerance
goals,
for it.
tolerance,
Yeah.
right?
Time horizon.
Appetite, time horizon.
Exactly. So for me, would I do it? I did it.
Yep.
And I did it without hesitating.
Yep.
Because I knew I knew my situation.
Yes.
Right?
Yes.
He needed someone to kind of guide him towards his decision.
Yes.
And that's the importance of having an investment advisory coach.
Yes.
So it doesn't have to be me, but I'm just saying, one of the things that I have is
You're a fiduciary, right?
Yeah, it's an investment advisor representative license. So you can always look me up on the SEC's website under advisorinfo.sec.gov. You can look up my name or anybody else's name, and you can see their credentials.
Yes.
You can see whether or not if they've been disciplined or anything like that in the past. And I think it's important that you get yourself some kind of an investment advisory coach, because I know if you're like me, friends and family gave me advice when I was younger, and that was like the worst. It's unfortunate. I mean, I know they meant well,
Yes.
but again, I'm not gonna go, excuse me, I'm not gonna go to friends and family and ask them, how do I lose weight?
Yes.
Like diet and exercise. Well, yeah, okay. Everybody knows that, but I mean, there's something specific. So maybe I gotta go to the GI doctor, right?
Yes.
I gotta go to the allergist. I gotta go to my primary care physician,
Yes.
and I'm happy to pay those people.
Yes.
So I think, and again, it doesn't have to be me, but just find yourself someone who can give you good advice. If it's something about options, I mean, I love trading options on oil. I know it. I know it inside and out. That's fine. But that's me. And, if you're looking at, okay, I want to buy, I want to know about real estate. Maybe there's someone there who specializes in real estate,
Yes.
deals, or commercial real estate, or flips, or, stocks, or currencies, whatever it is. Find that person and seek them out and use their services.
Yes.
So I hope
Use a
that-
professional.
Yeah, use a professional, really, because this is your wealth at the end of the day. And
There was a question here about.
I'm looking at this now.
Yeah, risk, and my kids are young. So, one also way to get your kids' feet wet when they're young actually is
That's beautiful.
to do, what
They can take higher risks.
Yeah, no, they couldn't, and they have time,
They
right?
have time.
So
Cash flow.
Cash
They can
flow.
get, yes.
So time is great to monetize when you're young. One of the great secrets that many people who have been in this country for multiple generations, they know this secret, and many people who haven't don't. And that secret is insurance. So if you have some young kids and they want to get in, but you don't want them to kind of get burned, and then lose taste for the market, insurance is a great way for kids to participate in the market without having to worry about the ups and downs too much. And it gives them an asset that grows, that they can use very early in life, like for college, for their first investment out after they get out of college.
Well, what kind of insurance?
So,
It can't be term insurance.
so term is going to be gone. So it wouldn't be term. And whole life is just straight up interest, right? So
Sure.
not whole life, sorry.
No,
Whole life, yeah. It's insurance, it's interest. But then there's
but it's a cash value. That
it's a
accrues.
cash
That's what
value.
you want, yeah.
And you want just a straight up whole is just collecting some minimum interest rate. But what you really want is to be able to take risk in the market with your insurance, especially when you're young, but have your loss capped. And so they've moved beyond the typical whole life policies. Now whole life can actually participate in the market itself. And just like an option, a put option protects you, they protect you in life insurance policies now against market drops. This way your kids can realize that they're building an asset, building value over time by participating in the market, not paying taxes because it grows tax-free. And then if they ever wanted to take it out, let's say pay for college, pay for their first house that they want to buy and invest in, insurance is liquid. They don't have to wait like an IRA or a 401k or a Roth till they are retirement age. So
Yes.
that's a great way for kids, because I saw it said, I'm trying to see how my children, can get their feet wet now.
Sure, sure.
And one of the greatest things we talk about, premiums. Premiums are extremely low.
Because your children are young.
And age is the number one
Yes,
factor.
for life insurance. Because again, each day that you're on this planet and alive, the probability of you dying gets higher and higher.
Exactly. And what people don't realize, why would I ever buy a life insurance policy for my child? Well, you're not buying it necessarily for the death benefit, because nobody, we all pray that our children live a long and healthy life.
Of course.
But they can use that as an asset to basically either borrow against themselves or liquidate and then invest that as their first investment.
Sure.
Whereas we always think the first investment of my child will be when they get their first job, save enough money. But you've given
education.
them
Education. Before education, you can
this
buy
is
all
before, because this could pay for your education.
education. Yes, it can.
And a lot of people don't realize that that's one of the fewest things that are legally not included in your financial aid application is insurance.
Yeah.
Even your 529 savings plan
Yes.
is included.
Yes.
All your real estate is included. Two things are
Stocks
not
are.
included.
Yes, absolutely.
Stocks are.
Yeah.
401k, Roth, any IRA is not included, as well as life insurance is not included.
So we have a question. How do you borrow against your own insurance? Well, if it's term, you can't. But if
it's whole life,
yes,
it's an
you can.
asset.
When you say whole life, I just want to make sure people know the difference between whole life and the permanent insurance. So there were
Go ahead, Yoshi.
the whole life is one of the things. There is others like a permanent insurance like BUL, IUL. Those are BUL is strictly on the stock market they use.
Up and down.
So during the class, you are going to find out that asset value that where it has a more conservative value, but you have a higher gain than whole life.
Yes.
So this is something, and people who is interested to learn during that class you have in life insurance or one of the class you have, right? Yasser is going to cover, and then we have a couple other security advisors that are going to come in and join, help to make sure to open up and to show you how you can create this cash value where the whatever money you put in there. I do not know if people know Disney, how Disney started his business. Disney, I'm sure you all know that Walt Disney today.
It's one of the stocks everybody wants to buy for their kids first.
That's how he started what he did, he invested his money in one of those things in permanent insurance.
Yes.
I want to make sure.
You can just mute the line right there, 848.
From the permanent insurance, he borrowed money from the permanent life insurance, and then that's his seed money with the business.
There you go.
So you can use it. So people, that's another liquidity that Yasser mentioned earlier. Put your money someplace is not even locked in. So that's what he did. And then once he just took some advantage of tax-free and so on.
We're about to wrap it up, so if you can still mute your phone lines. We've got about 8 minutes, so I really want to keep it to Q&A because, I mean, God knows I have other things to look at, but, you can always look at them. to look at the courses that Mushi was just mentioning. So I've got like a beginner and an intermediate and an advanced course if you really like to take them. So again,
You have control?
what's that?
You have control of the...
Of the mutes? No, I don't. But I know we've got, I don't have much idea about life insurance. Can we cover this in more detail later in a different class? Everything that we've covered today is going to be covered in a different class in far more detail. She had something to say. Go for it, Mushi.
So, like,
Listen, and if I don't have any affiliation.
Yeah, if you
I
could
really
just,
want to then.